over a longer term,
Yeah.
which leads this to be a structural impact where potentially prices could be higher and they make bigger profits, at least for the next 10 years.
In the last decade, Exxon per year, 4% per year. I mean, it's all recent. It's all.
Hey, this year's been a big one, Tom. Agreed.
Let's move on right now. We're going to do that as we look at foreign exchange, the dollar. We can look at international economics, what Nathan Sheets said yesterday of a global slowdown. We do that with William Lee, chief economist at Milken Institute. Billy, thank you so much. Are you as gloomy as your good friend Nathan Sheets? Can you give me a global GDP of sub 3% for next year?
It'll be even more of a sub 3% if China doesn't get its act together. And given what's happening in China now, it looks like it's not going to happen. So Nathan's a little optimistic because I think he's not revised down China enough, perhaps because of political reasons.
What did you learn from the Congress of President Xi? Of course, the emotion we saw in that video, I believe it was just a week ago. But Billy, what did you learn? And particularly, what did you learn about Xi in Hong Kong?
I think every Western investor is going to have to reassess political risk right now because China's focus is going to be to turn inward. They're going to say, we care about safety. We care about the threats to our country. We have to worry that the world is gathering around us. And so instead of having policies that strengthen growth and bring back growth and productivity, they're going to be looking at national security, national safety. That diversion, I think, is going to mean a lot for Western investors because anybody who goes into China now has got to tell the Chinese government that we will help you make your companies national champions. And unless we are doing that, we're not welcome.
Bill, you slipped it in there. Wasn't lost on us. Do you think the South side refuses to downgrade China sufficiently for political reasons?
Well, John, we've been here before, and I think I've gotten some feedback from my friends that have guns to my head now. But I think that there's a lot of pressure for companies who are in China, well-established companies like Citi, like JP Morgan, as financials, who need to have a presence because that's the nature of their global business. And if they start getting too pessimistic about China, I think one of the things that's going to happen is that they're going to start getting cut out. And in order to keep their business models going, they have to be cheerleaders for the administration, no matter what they're doing.
How long will China remain an opportunity, though, for some of the multinationals? How long can they continue to basically play by the rules as put out there by the Party Congress when the Party Congress just basically said, we're not sure if we want you?
Lisa, the companies that are there will stay there. But the real question is, where's the marginal dollar going? Where's the marginal investment going? And I think, given what's happening in China, at least for the next several years until the dust settles and we get a clear direction for where deal circulation goes, the marginal dollar is going to be going to ASEAN and Korea, because those are the opportunities, those are the growth zones. Because China has diverted away from the companies that really have given them the growth over the last several decades, the high-tech, highly innovative private sector companies. Xi Jinping has made it very clear, going forward, we're going to be emphasizing growing our national champions and state-owned enterprises. Well, that is almost an oxymoron to say highly productive state-owned enterprises. So the marginal dollar, the smart marginal dollar, is going toward ASEAN and Korea.
Bill, in the past 5 days since the Party Congress had ended, we've seen a 9% decline in Chinese stocks traded in Hong Kong. It is a record decline in the equity markets following this meeting. How much do you take a signal from this that's lasting, where foreign money will not be welcome in China, it will not return, and there will be a very different look with a much slower growth profile for a longer period of time in China?
Well, Lisa, not only have valuations gone down, but the actual number of dollars is coming out. And I think that says a lot about both supply and demand. The Chinese have said, you're not welcome unless you're helping us develop national champions. And quite frankly, the desire to be in that huge market has gone down because Xi Jinping has made it very clear, this huge market is for Chinese companies. If you're going to help us develop the Chinese market for Chinese companies, come on in. But if you're not going to be doing that, if you're going to be doing what you've been doing for the last 100 years, exploiting us, stay out. And that's I think, a very clear message.
Billy, I was thunderstruck at the meetings in Washington that you used to live and breathe, at how people weren't talking about Fed talk and central bank chatter. They were talking about dollar liquidity and swap lines. As we go into this weekend, give us the Bill Lee swap line update. Is it something to worry about?
Keep an eye on what QT does to bank liquidity around the world. That's where we're going to see the drying up of liquidity, because I don't think the Fed has really realized that it has to really have strong repo markets and non-bank markets in order to facilitate the the withdrawal of liquidity from the banking system. And once that happens here in the United States, it'll have global implications around the world, because liquidity not only will dry up here, it'll dry up way around the world.
Does that fold over to a more accommodative monetary policy? Does the balance sheet and repo challenge become a discussion at the Fed press conference November 2nd?
Tom, bite your tongue, because the one thing the Fed cannot afford to have anyone say is they're not credible. And any kind of inflection point now, before inflation turns around, is going to destroy that hard-won credibility post.
Yeah, but Bill, we have a hard-won credibility with a balance sheet that William McChesney Martin never envisioned. The two, and John Farrell's been great at this, the two have to dovetail together. What do you predict over the next 3-4 Fed meetings is they dovetail balance sheet dynamics with some form of monetary theory?
John has been very spot on to say, keep an eye on the Fed and ECB, because the place they're going to blink is not so much in the rate and the speed by which they raise rates. It's going to be how they do QT. ECB has a huge aversion to anything starting with Q. So we know they're going to be QE forever. But the Fed may actually start to blink, because if financial stability starts to rear its head and we have volatility in the repo markets and non-bank markets, that's where you're going to see some easing. And that will be caught by markets, and we will start to lose the credibility, and inflation expectations will start to take off again.
Hey, Bill, wonderful. As always, Bill Lee there of the Milken Institute. We're looking at the ECB, not just the Fed. I'm impressed with this this morning. It took us about 38 minutes before we discussed the Fed, Tom. And it was you, not me or Lisa.
Did you okay?
So there we go.
No,
CPI.
He said you're spot on. And Bill Lee never says I'm spot on. It's always
He told you to bite your tongue.
I know he did.
Can you do that for 10 seconds?
Bill Lee time. I'm trying.
Just as I go through the CPI
3, 2,
data out of
1.
Italy. 12.8%, Tom, CPI in Italy this morning, year over year. The estimate, do you know what the estimate was? 9.9. That's a big upside surprise.
It's a big upside surprise, and you know, it's a bunch of elite stuff with. I pulled out one of my ancient bow ties today. It's a bunch of elite stuff with fancy bow ties and beards that need to be shaved. And the bottom line is, you know what? It's not about elite idiots like us. Italy's flat on its back.
It's a struggle.
Take us south of Rome. Nobody goes south of Rome except Sicily. What's it like down there? They're flat on their back.
Look, where my family are, Tom, it's a very, very tough time, of course. Yeah. It's a struggle, and always has been historically, and needs to get a whole lot better.
12% inflation?
It's a cost of living crisis, Tom. We know that. In Germany, though, I think this is the key difference between now, Lisa, and maybe 10 years ago. The weak spot in Europe right now is Germany. It's Germany, and I'm looking at the breakdown of the regional stuff for CPI in Germany this morning, and we'll get headlined in about an hour and 20 minutes. It ain't great.
It's not great. You did see an upside surprise with respect to GDP in Germany, and a downside surprise in France and Spain. And this is partly because the weather hasn't been as bad as people thought, right? I mean, essentially, you haven't had the same kind of pressures. That said, how does this equation change, and where does the balance of power go, particularly given some of the heat that Italy has felt to be austere, to not invest in some of these things in previous years?
Given where 3Q GDP just came out in Germany, which was better than expected, and we need to highlight that, and given where CPI is this morning, Lisa, you'd have to imagine it's going to be difficult for this ECB to back off anytime soon, regardless of what they told us yesterday.
Well, and this is the reason why people are expecting them to keep going. And if they don't, that could be a real liability, with the long end really taking off in terms of yield.
Equity futures right now, negative 0.6% on the S&P 500. Amazon getting hammered in the pre-market, down about 12%. Apple just about holding on. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk is cleaning house at Twitter. He's completed his $44 billion acquisition of the company, and Bloomberg's learned he's gotten rid of the CEO and other major executives. Musk plans to be Twitter's chief executive for now. He also intends to do away with permanent ban on users, a category that includes former President Trump. Meanwhile, the former president shelled out $20 million this month to support Senate candidates he's endorsed. The money came from his $92 million in donations, the most in the Republican Party. It's being used for advertising in Arizona, Georgia, Nevada, Ohio, and Pennsylvania. In a new Bloomberg survey, economists predict the Fed will keep laying the groundwork for interest rates to reach 5% by next March. They expect that to likely trigger a U.S. and global recession. Next week, the economists see policymakers raising rates by 75 basis points for a fourth consecutive meeting. In China, Premier Li Keqiang has repeated pledges to stabilize the economy and stimulate growth in the fourth quarter. Li says it's crucial to implement measures addressing the lack of effective demand and to boost consumption. This week, data showed China's economic growth accelerated to 3.9% in the fourth quarter. And Volkswagen has cut back its sales expectations for the year. Europe's biggest car maker now sees deliveries on par with last year when semiconductor shortages were severely hampered output. VW is still being hampered by all the availability of chips, and logistics remain a challenge. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
that inflation is too high. The president gets it. He's been working to get gas prices down. So as a result, they've been coming down for the last 3 weeks or so. But we understand that that's partially due to the war in Ukraine, and we need to keep oil on the market.
That was Cecilia Rouse there, the chair of the Council of Economic Advisors. Let's get you up to speed on the price action this Friday morning. Good morning to you. Equities down 0.7% on the S&P 500. Yields much higher. Trying to reclaim a 4 handle on a 10-year. We do
There
that.
it is. Bingo.
Just for you, TK. In the FX market,
The 4
euro dollar,
digits.
99.37 on euro dollar, negative a third of 1%. CPI out of Germany, 1 hour and 12 minutes away, Tom. Looking for a punchy number there too.
Surveillance difference, John. Let's go over this. When we do data checks, folks, often we go to 3 digits, 4 digits. There's each thing. There's a convention. There's a way to do it right, and we do it the global Wall Street way. We were already screaming about that.
That's a team effort, Tom.
Team effort. Just team surveillance, trying to get to 4 digits.
We do the Dow sometimes too.
We do the Dow Jones Industrial Average as we can. Of course,
Bang.
outperforming. Do you know that the Dow 1 year trailing is out of correction stage? It's
Nice.
9% down. I think most people don't know that.
I like to look at the equal weight S&P 500
That's
too.
very cool too. And the
Yeah.
value line geometric is my all-time favorite.
Just to strip out the muscle of big tech,
Yeah.
just to show what's been going on more broadly.
You know, next week we cover the Wilshire 5000.
Nice.
Ellen Wald is the only one in oil that understands what the Wilshire 5000 is. She's senior fellow at Atlantic Council, and we get a brief on oil. Ellen, parse Exxon with a 10-year total return of 4% per year as compared to the moonshot of the last 24 months. Does someone like you, an academic, do you just assume big oil can sustain the moonshot?
I'd say basically what we're seeing is the boom bust cycle that has always been evident in oil and commodities, but oil in particular. You know, things were down for a while. Now they're way up. The big question is the typical cycle that we see is we get big investments in CapEx when oil companies' profits are high. And I'm not sure that we're going to be seeing that this time. And that could be a huge problem.
That's a constructive idea in that the rap is when things are good, they go off to the Arctic tundra and waste billions of dollars on a project that never pays off. Are those days over?
I definitely think those days are over. Everyone seems to have learned their lesson from that. The question is, are we going to see more than, say, $20 or $24 billion in CapEx investment this year from Exxon? And Exxon's one of the companies that actually is increasing production. They've increased production in the Permian. They're doing a lot of work in Guyana. They've made a lot of great discoveries there. And they really have a potential, I think, and the mindset to really go out there and do a lot more investment. But if we don't see more coming from them, I mean, put this in perspective, their profits this quarter are equal to what they're basically spending in CapEx for the year. That's just not nearly enough. And in today's environment, today's price environment, what we're seeing in terms of global production, we need massive amounts of investment now so that we actually have oil and gas in the future.
So, Ellen, we were talking about the political liability for the Exxons of the world, of which there's one. It's Exxon, I suppose, raising their dividend by 3 cents to 91 cents and really reporting just blockbuster earnings. How much blowback from the White House? Who has the upper hand here, though? Because Exxon could come back and say, look, we're actually providing the oil and the natural gas that you need to lower prices for consumers.
Yeah, that's a really, really good question. And there's definitely this back and forth going on with the White House. I would definitely expect to see, the White House come out guns blazing. Midterm elections are coming up and they're going to blast these oil companies for what they're doing with their profits and for the prices that consumers are currently paying at the pump. But that doesn't necessarily mean that they're going to actually do anything to potentially harm these companies. Now, what's going on now is we've got lawsuits in a number of states, more than I think 24 across the country, that are trying to basically get oil companies, Exxon, Chevron, ConocoPhillips, and others, to pay for infrastructure damage from climate change events. And the question is, are these lawsuits going to get thrown out, or are they going to go forward and could potentially be major drains on these companies' funds? So this is something that the White House could potentially influence and say, hey, pull back. I don't think they are.
Ellen, the heart of this really is a question of how long the transition to a more dominant presence of cleaner energy we have ahead of us, right? I mean, if it's a 10-year window and some of these big oil majors are investing heavily in this, then there will be less cloud and there'll be less of a concern. How far away are we? What is the time frame? How significant will this be changing in terms of the sources of energy in a decade?
I think we're a lot farther away than we think we are, and that we think we are based on these companies' investments. If you look at the investments that they're actually making, particularly the American ones, the European ones invest a lot more in renewables than the American ones, and as a consequence, their profits this quarter are like 13% lower than the American companies. But a lot of these investments aren't real. So look at Chevron. They were a bit down because of their refining margins, but their sales for products were actually up because they acquired a renewable fuels company. Well, if their sales are up, but their profits are still lower, then is that company really worthwhile? Are these renewable fuels or synthetic fuels really profitable? And I think that's the question that these companies have to ask themselves as they go forward in this environment.
You moved on too quickly from that point. Can we sit on that, Ellen? Just for one more, the idea that the older energy companies not making the big renewable shift are doing better this year than those that have.
I mean, that just tells us that oil and gas, legacy oil sources are still absolutely vital to our society, to the way that we function, to our modern life, and that they're going to continue to be. It's not like, just because people have decided they want to ban the sale of internal combustion cars in 2030, that means that we're all suddenly going to have this magical, great, renewable source of fuel and transportation. That's just not likely to happen. And I think it is more likely that we will continue to see a very slow transition unless there's some extreme major breakthrough in technology. And oil and gas will be very important.
And well, thank you of the Atlantic Council. I feel like many people just sort of got slapped in the face by reality this year with the energy story. Tom, the reality of a war in Europe, the reality of the politicians, political relationships breaking down, whether it's Saudi and the United States more recently, and Russia and the rest of the world, much of the world, over the last year.
In the social aspect, which Ellen, by the way, folks, captures brilliantly in her book on Saudi Arabia, John, the social aspect here is emerging markets, developing economies. They are energy intensive and they are energy hungry, and they're using energy as a tool to catch up with the developing world.
Yeah,
that's
well
a core thesis.
Without a doubt.
Did I do okay there?
That was wonderful.
I'm killing it.
Would you like?
I can leave right now.
I'm going to give you a data point in the morning, okay? This comes from Kevin Crowley here at Bloomberg. The dividend hike from Exxon makes it now 40 years of consecutive increases. 40 years.
I've always underplayed this. Remember the new Hermes building on Madison Avenue was Bank of New York. And
have you seen that?
They've had dividend increases since. I haven't been in. I wouldn't shop at Hermes, but
of course not.
Thank you. But I lost my train of thought.
Lisa's sitting there thinking, I swear I saw you in a Hermes bow tie earlier this week.
I just shrugged that off. I was like, all right.
They opened in Shanghai 2 days ago, megastore.
How busy are they?
They're busy.
I'm sure. I'm sure. This is Bloomberg, apparently.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. it's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. When U.S. inflation numbers are released,
the score is inflation 1, Fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Demand seems to be recovering too fast for supply to catch up. There is a case for the ECB to hike into a recession, of course.
Yes, it has to do some and make some fairly painful and unpalatable decisions when we are undergoing a slowdown.
We're calling next year rolling recessions in the global economy.
We are getting closer to that point where the Fed can decelerate its pace of hikes, but we're not there yet.
Everyone here is making it up as they go because we really have not been in this position for so many decades.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a week. How many times have we said that this year? Yeah. What a week. Live from New York City this morning. Good morning, good morning. For our audience worldwide on TV and radio, this is Bloomberg Surveillance with Tom Keene, Lisa Abramowitz, and Jonathan Farrow. Futures down, Tom, by 5 or 6 tenths of 1%. I said it a few times this morning already. Apple just about holding on.
Apple holding on, and maybe the one constructive story out there. I mean, oil, big constructive story this morning with Exxon and Chevron as well. But you're right, and what it really means, John, is you can't...
Down hard. Lisa, Amazon, down 12.6% in the pre-market.
And we've been talking all morning about how the performance of these shares in the aftermarket are probably more interesting than the actual earnings. What I find really fascinating, Anurag Rana of Bloomberg Intelligence coming out and saying he had already downgraded his expectations substantially. And yet they still disappointed. And it's not just in real time, it's the forward look. How much of this is due to international? How much do we start to discuss about the idea of the weakness around the globe becoming the U.S. problem and really calling for some action?
You mentioned that this morning, John, and to me, Lisa's dead on. This is an international rate of change story.
I couldn't agree more. We'll get CPI a little bit later this morning out of Germany. Looking forward to that in about an hour. I'm sure Germany's not looking forward to that because that read's going to be terrible. Is Anne-Marie joining us this morning?
Yes. I believe she is on our schedule.
The
She's
politics
fitting us in.
of these oil earnings this morning. Lisa, that is a big deal.
Especially because this is basically one of the linchpins of this administration. They've said, we are trying to combat inflation by bringing down gasoline prices. We're going to do everything that we can, and they can see those profits that are the biggest ever.
Okay, but are we going to allocate capital like Europe, where they're going to go after Total profits, windfall profits, or are we going to have windfall profit tax here?
We have 2 weeks. what can they actually do other than just simply malign them? I mean, other than, I mean,
I like how you looked at your watch that isn't there to tell us how many weeks we've got until the midterm.
I have weird habits. What can I say?
You see that?
It was
like that.
terrible
I thought
on
that it was
radio.
great, you know?
Bramo crushing it. To your point, there's a message
Every
here
day.
from Exxon
Yeah.
to the White House, and it reads as follows. The investments we've made, even through the pandemic, enabled us to increase production to address the needs of consumers. That's from the Exxon CEO this morning. I don't think they're going to read that out loud at the press briefing over at the White House.
No, especially because the profits are so big and the investments are not really that big. I mean, Ellen Wald was saying it's basically a rounding error for them. And how much can this really play into the hands of the White House at a time when they are raising their dividend for the 40th straight year?
Fold in Anne-Marie Horton here, and this is important. And Greg Valliere with a blistering note of what everybody notices now, Democratic panic. And his simple phrase is, even New York. I mean, you know, what is going to be the Exxon debate, the Chevron debate, if you have a substantial Republican House, dare I say, a Republican Senate, and what does that mean for Democrat and GOP politics adjusting to 2024? How does that fit into oil?
Throw in the Fed debate as well. We can throw in the
How are you gonna
politics,
throw in
a
the
little
Fed
sprinkle of the
debate into
politics around the Federal Reserve too. Another Senate Democrat coming out and asking the Federal Reserve to pause interest rate hikes.
Although this was more aggressive.
Oh, this was way more direct.
And that's really interesting. Sherrod Brown took a more reserved stance, saying this could be problematic. This new one was basically saying, stop it already. Just cut it out. You can just pause it, and we're going to be fine. Just don't torpedo the economy.
Like a parent to a child.
100%.
Stop it already. Futures right now on the S&P
Remind
down
us.
about 0.6% on the S&P 500. Chairman Powell, the child in that scenario. For the senators at least. What do you make of that, Tom?
It's always the battle, and again, it has to do with moving from Stan Fisher's ultra-accommodative to some form of neutrality. You mentioned James Dimon talking about now the heavy lifting begins. Well, we're there, and November 2nd, I got to get the calendar out. I'm sorry, I don't have the Fed meetings memorized. I memorized Bank of Japan meetings.
You've got the Fed meeting right.
November 2nd, December 14th. I may work both days, which would be good.
You're going to turn up?
I might show up.
That would be nice. Lisa's going to be here too. I promise to be around as well. Lisa, Tom's going to show up.
I'm so pleased to hear that, and we'll get some Fed speak right after, so we can look forward to that. And what we're looking forward to today is the last slew of data before that particular meeting, but also before the election. The last data that I think is really going to make a huge difference. U.S. Employment Cost Index for the third quarter. How much do we start to see the pace of wage hikes decline versus the opposite? Actually see it increase because there is signs of tightness of labor, particularly in certain areas. We also get U.S. personal income and spending for the month of September. I'm actually curious how much people are spending on borrowed money. We just saw credit card borrowings go up to the highest levels going back to 2019. So that might be part of the reason why we're seeing people continue to spend. 10 a.m. we get University of Michigan sentiment survey for the month of October. How much does continue to directly correlate with gas prices, gasoline prices? They typically, when gasoline prices go up, this survey goes down. How much does that affect the election? And today we do get an ongoing churn of earnings. We did get Chevron and Exxon earlier this morning. Later this morning, we hear from Mike Wirth, Chevron CEO, Scott Sheffield, CEO of Pioneer Natural Resources. Both those shares popping in pre-market trading. But John, as we've been talking about, the political ramifications, what is the blowback going to be like at a time when people are worried about how high gas prices are? They're worried about the winter. And then you see these companies making bank.
That's a great lineup a little bit later this morning. I'm sure Alex Steele and Guy Johnson are going to crush that, Tom, a little bit later, 10 a.m. Eastern time, to hear from some of the oil majors.
Yeah, well, they're going to hear from the oil majors, and they're going to send, but John, they're going to spin it with the optimism of a changed political landscape in Washington. They've got to slot that in.
Well, I think
right now with the dynamics that we're seeing.
The administration is going to have some things to say this morning, no doubt.
Yeah.
Katie Kaminsky joins us now, Chief Research Strategist at Alpha Simplex. Katie, you're much more than that. You guys have had a massive year. Katie, can you walk me through what's worked this year and what hasn't worked this week?
Yes, that's a good question. I mean, in the first part of the year, the narrative was inflation. So we were very much seeing long signals in commodities, short signals in fixed income for the first time since 1994. But later in the year, this narrative has changed. It's been a draft between the recession fear versus rising rates and the impact of the relative strength of the dollar. So the dollar trade has probably been the biggest mover since the summer, and this short bond trade continues to be the focus of many of the technical community, those of us who follow momentum signals.
Catherine Kaminsky, into the weekend, everyone is going to read on Turtle Trading, John Henry, and Alpha Simplex. You are up 40% plus this year using trend-based studies. Explain to our audience what you didn't do to generate a return larger than the triple leveraged all cash fund.
So trend strategies are really about following what the market is doing, not what the market should do. And I think that's where we're in a very good position because frankly, nobody knows what the market is or should do going forward, given the complexity of the new macro environment that we're in. So I think in that sense, it's really been difficult to make a call on something that most investors have never lived through. And in a different macro environment than most of us really have sort of been used to. I mean, look at the correlations. Today is a perfect example. Today we have stocks down, bonds down, dollar up again. And that's a very strange cross-asset theme, but it's the prevailing theme in this type of environment.
Katie, can you find any kind of theme when it comes to the optimism in stocks, perversely, from this idea that the Fed's going to back away, and then the pessimism on the tech in the tech universe after some of these earnings?
That's a good question because, like, earnings coming in is just another data point that people have to absorb to try and understand this narrative. And when we look at what's been happening now, obviously duration exposure is something that a lot of tech investors are thinking about, but also the fact that you're really seeing that divergence across sectors, across economies, across the world. So we're really seeing, even though there's key macro themes, these macro changes are really creating winners and losers in this particular environment. Trader or someone that's looking for sort of deviations from the mean. It's not just a stocks always go up, buy your 60-40 environment this year, which means that there's opportunities for those who are a little more tactical.
Katie, you've been tremendous this year. Congratulations to you and the team. Katie Kaminsky there of Alpha Simplex. Tom, I do wonder, do you think anyone's ever walked into like Schwab somewhere on Main Street and asked for the triple leverage all cash?
Oh, they do. Yeah.
Do you think they've ever asked for an allocation?
I got a book and treatment on this right now.
I've always wondered.
Sure.
I want that.
Yeah, exactly.
No, I mean, triple leverage is a little difficult. There's a white paper that was put out years ago that the leverage pivot point mathematically is 2.8 to 1. But because of the marketing goose we're getting, we go to 3 to 1 instead of 2.8 to 1. And what really makes it worthwhile is with a triple leverage, I can get a 2 and 20 split in the fee.
Nice.
Versus a normal money market fund fee.
Are you ready to retire this year?
No, we don't think this year. We need to see rates come in. We need to see the Fed to blink before I can talk about retirement.
Just, can I do a public service announcement?
Please do.
This is made up right now. So anyone going to be looking for this triple leveraged all cash fund, please use your time more wisely.
I thought a disclaimer ran across the bottom of the screen for the whole show. You have to do that periodically. I thought it was down the small print.
It's in the small print. Please disregard everything that you hear.
We're looking at an international fund. We're looking at an international fund, but I can't get the 2 and 20 if I go international.
In all seriousness,
FIS in London is really a problem.
Trying to get out of this. I started it. Futures down by 0.7% on the S&P. Big turnaround in the bond market, up 9 basis points. What you'll notice in Europe is that yields were lower in Germany by something like 15 basis points. This morning, they're higher by 15 basis points. I don't think this bond market volatility, Lisa, has settled down really in a material way at all.
I would completely agree. And it goes to the point that you were talking about German GDP earlier. It came in higher than expected. So this basically gives more of a pass to the ECB to keep hiking rates and shows that things are not cooperating as much as they would like.
Chris Lowe of FDN did a fabulous note yesterday tearing apart the optimistic GDP number of America.
Are you being pessimistic?
You're
being pessimistic.
You sound less constructive.
Yeah, on a net export basis, Chris Lowe hit the ball out of the park yesterday.
Do you want the president's words on it? I wrote it down.
Oh, please.
I'll find them for you. With today's third quarter GDP, we got further evidence that our economic recovery is continuing to power forward.
There we are, the anti-Chris Lowe.
Yes, somewhat different to what the economists are saying. Futures down 0.7. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk has begun putting his stamp on Twitter. The world's richest person closed his $44 billion takeover of the platform and has begun firing its major executives. Bloomberg's learned Musk plans to assume the role of CEO. He also plans to do away with permanent bans on users, a category that includes former President Trump. Hopes that the Eurozone can stave off a recession got a boost today. Germany defied expectations by reporting another quarter of economic growth. The country's gross domestic product rose by 0.3% in the third quarter. But momentum slowed in both France and in Spain. French growth went from 0.5% to 0.2%. In Spain, GDP rose a worse than expected 0.2%. Big earnings for big oil. ExxonMobil posted the highest profit in its 152-year history. Natural gas demand and prices surge. Exxon's earnings are expected on track to exceed $500 billion for the whole year. It was a similar story over at Chevron, which posted its second highest profit in history. Again, it was soaring natural gas prices stemming from Russia's invasion of Ukraine that drove earnings. And Amazon has shocked Wall Street by predicting the slowest holiday quarter growth in the company's history. It says sales during the current period will rise just 2 to 8% as shoppers reduce their spending in the face of economic uncertainty. Shares of Amazon were down by a double-digit percentage in pre-market trading. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps will surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
No one covers the world like Bloomberg.
Because Trussonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. season is here.
The earnings are starting to pour
The
in.
numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going to cross the wire.
A big beat. Stock is up more than 8%. Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Making these chips in America is going to help lower the cost for families looking to buy a car, to replace your washing machine, get a new cell phone. It also helps companies outcompete the rest of the world. And I've heard from Xi Jinping that he's a little concerned about that.
President Joe Biden there. We'll talk about that in just a moment. Good morning to you, or happy Friday, as some might say, with Tom Keane, Lisa Browers, and Jonathan Farrow. Reason I'm laughing in the commercial break, Tom. You hate Happy Friday.
I hate it with a passion.
Why do you hate Happy Friday?
I hate it for any number of reasons, but let me tell you this. You go in
Sure.
Wall Street, you go in on Saturday, and you get more done on Saturday
Yeah, I mean,
from 8 to 11 a.m. than you do the rest of the week
The
combined.
top tip on a trading floor, maybe don't walk in as an intern and say to everybody, Happy Friday.
Okay, I say Happy Friday to him, true story.
I hate it.
And he says, what's good about it?
What's good about it?
What's good about it?
Well, it's Friday.
Happy
Good
Monday.
morning. I'll say good morning.
Happy
What's good
Monday.
about it?
Friday does my head in. I hate that.
Oh, yeah.
Happy
I'll
Monday,
keep that
and
in mind.
Monday starts 7 p.m. Sunday night when Japan opens.
Try 2 p.m., Tom. Much earlier.
We're a
for
joy.
a lot of people.
What's that, Dubai?
That's not when Japan opens. But anyway, futures are down by 0.6% on the S&P. We got some pushback from another Democratic senator, this time John Hickenlooper, Tom, who said this of Colorado. High inflation necessitates a response, but the concern is the Fed is doing too much too quickly. I write to urge the Federal Reserve to pause and seriously consider the negative consequences of, again, raising interest rates. So we've got Hickenlooper, Sanders, Warren, and Sherrod Brown now, Tom.
It is a movable feast 2 weeks before the election into an interesting weekend, to say the least. Anne-Marie Horton with a brief from Washington. Anne-Marie, I'm going to go to some of the statistics that you see on food inflation. Food inflation is something like 11.2%. The average back to World War I is 3.4% per year. Does anything else matter?
Well, a lot of other things matter. Food inflation is one of them, how much people are paying in rent. I mean, we've been talking about for months about gasoline prices. It's the one thing that actually the White House really wants you to know, is that those prices are down, even though they say if you look at market dynamics and the refining margins, they should actually be closer to $3.20 across the average. But Tom, the heart of the matter is whatever it is that is going up, consumer prices across the board are going up. And this is why the polls, especially in the last final weeks going into the midterm election, you see them tightening. And even in some places, like we were just talking about before we started the program, places like Oregon and the governor's race starting to tilt towards this potential Republican win. And a lot of this has to do with not just the economy, but also really this candidate taking aim on homelessness, on crime. But that would be a huge defeat for the Democrats, just this one particular race, because we haven't seen a Republican governor since the early 80s.
We stagger through the Sunday talk shows. Look for Face the Nation, among others, on Bloomberg Radio in the afternoon. Hugely popular. Anne-Marie, great. We get through the Sunday talk shows. How do the two sides recalibrate given the dynamics of the last week? What's the plan next week?
So for the Democrats, what you've seen them trying to do is, at first they really wanted to make this midterm elections about Roe v. Wade, right? And really about abortion rights. And now they're realizing they need to talk about the economy. So their argument is that you cannot leave it up to the Republicans in terms of making, terms of the next few years and what that would mean for the economy. And they're really trying to tout the legislation they've got done, the Inflation Reduction Act, and of course last summer the Hard Infrastructure Act, where they worked with Republicans. For the Republicans, the message hasn't changed. It's been for months. Inflation's at a 40-year high, and they say that the cities are more dangerous and people are upset regarding crime and in some cities homelessness. That message hasn't changed. What you have seen is the Democrats kind of weave in between we're better for the economy, at the same time Roe v. Wade is on the ballot, and they haven't really been able to hone in on one specific message.
What's the response to some of these earnings that we heard of the big oil, excuse me, I slipped because the leadership has changed this year, the big oil companies?
Well, we heard from the president yesterday going after Shell and their profits as well as their dividend. The president saying, why are they giving money back to shareholders? They should be giving it to consumers and bringing down pump prices. Wait till the president of the United States wakes up and sees the Exxon earnings. They're even beating their own profits, and they are having a dividend, 40 years consistent of a dividend. This is something that the Democrats are really going to rally against.
Did you see how she nailed that financial analysis? Anne-Marie just absolutely nailed that.
Thanks, Tom.
Well, remember, she used to cover the oil majors, Tom.
Really?
In London.
Yeah.
And also used to cover OPEC in Vienna. She's dabbled. I think she knows what she's talking about.
Okay, thank you.
Carry on,
If I could just say one more point about how the Democrats are going to use this. We already also heard from Senator Murphy. It's not just the president that's using the bully pulpit to talk about oil majors. You heard from Senator Murphy on Twitter talking about the fact that look at these profits, and also if Republicans get in power, then it's these guys, the oil majors, which by and large, there's not many people who love oil companies. He's saying that these are the companies that are going to be influencing the Republican Party.
Nobody better to talk about it down in D.C. than you. AMH, Anne-Marie, thank you.
Anne-Marie, thank you.
Anne-Marie down in D.C. on the oil majors, and I imagine maybe a comment from this White House, Lisa, a little bit later this morning.
Yeah, although how do you muddy the message at this moment? Because there's so many different messages, as Anne-Marie was laying out. You've got both the social issues, you've got the economic issues front and center at a time where an increasing number of senators are pointing the finger at the Fed, at them actually crimping growth and seeing that concern start to be more in the forefront. But, you know, I'm wondering what the cohesive message is when a growing number of Americans cannot afford the basic staples of their life, even as the upper crust continue to buy.
You look for someone else to blame, don't you?
Yeah, exactly.
And that's what seems to be happening, Tom, within 2 weeks of the midterms.
Yes, that emotion is there as well, but I'm just going to go back to basic stuff. Food inflation of 11.2%. Whatever the number is, I mean, it's above 10%. Let's make it double-digit food inflation. When did we see that, and how long did it persist? Most people alive today have never seen this.
Can I just say, you know, everyone's blaming the Democrats. If the Republicans were in power, everyone would be blaming the Republicans. The Republicans can just keep pointing the fingers and pile on, and then it'll be their turn, and then they'll have their situation. But the short-term back and forth, the frustration is, where do you get a meeting of the minds where people can actually say, look, we have some serious problems, but it doesn't play to the electorate. You know, it doesn't work.
Come on, back to 1802, it doesn't play that way.
Which is very frustrating for me.
Okay, but the fact is, since the beginning of the country, Alien Sedition Act, et cetera, it's always been just like it is now, massive polarization. Is Britain any different, John?
Not really. Both sides are always going to blame each other. Ultimately, though, what's the solution? If you get divided government, then maybe that actually does this administration a favor when it comes to inflation, because it'll be 2 years of being able to do nothing.
Right.
And ultimately, you know what's going to happen with prices if that's the case.
Well, the
you have to
muddle
imagine
through.
they come down because growth's going to get hammered.
The democracy of America is the muddle through, and that's sort of the success of it, ironically.
Sure. Futures down 0.5% on the S&P.
Yeah.
What about it?
147-ish, 148-ish. It's not off the radar.
Just sounded erratic, Tom. That's all.
Well, it's, it's
fine.
erratic
I
Friday.
don't mind. It's
Happy
a happy Friday.
It's Friday. What'd you call it, Friday?
and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions.
Live from New York, equity futures down 0.4% on the S&P, closing out the trading week just a little lighter, softer on the Nasdaq again, off by 0.8%. At least we'll talk about the success of fossil fuels and the failure of big tech this week in just a moment. That's the equity market. Look at the bond market, where we were last Friday and where we are this morning, 2s, 10s and 30s. Last Friday, front end of the yield curve, had a little look at 460. Right now, 435. We've backed away. Last Friday, we closed out the week for a 12th consecutive weekly gain in 10-year yields. This week, right the way back in by more than 20 basis points on the session. Yields up, but on the week, yields much lower. That's the bond market. Let's talk about foreign exchange. Euro dollar. Some euro strength on the week, unchanged on the session. The next stop for this one is about 30 minutes away. CPI in Germany. TK, CPI out of France, upside surprise. Out of Italy, upside surprise. Maybe just a little bit softer in Spain, but Germany at the heart of this mess. Germany's going to have a big one in about 30 minutes' time.
And we saw that from Italy as well. And the answer, John, is I don't need to know the number. All I need to know is the phrase double digit, and that's where we are.
Double digit CPI, growth set to roll over, and an ECB that's going to have to hike potentially a whole lot more. Look out for that in about 30 minutes. Euro dollar right now, just below parity. Let's get you some single names. We can do that with Bramo. Morning, Lisa.
Good morning. Today I'm looking at the differential between fossil fuels that are flying and big tech that is not, because John evidently knows me that well that he can know exactly what I'm going to say and how I'm going to frame it out. But it is the story of the morning. We've been talking about it. Chevron came in, one of its biggest profits ever. Those shares up nearly 2%. But again, these have been crushing it all year. Exxon is really the standout. A record profit, a profit that is expected to be bigger than a lot of major companies combined this year. It really is standing out. Those shares up just 2.1%. Because again, those shares are up more than 50% year to date. They are increasing their dividend, as Tom was mentioning, for the 40th consecutive year to 91 cents. And Pioneer Natural coming up also about 2%. Their CEO speaking on Bloomberg later. It's just sort of shocking to see the numbers that already had high expectations absolutely blow them out of the water. It is the opposite story in big tech. We heard from Amazon last night. We heard from Apple last night. Apple hung in there. Amazon did not. Amazon shares down 12%. Already those shares are down more than 33% year to date. So this really brings it to a pain level that we have not seen. Apple shares climbing up just a little bit, 0.75% after they beat expectations on the headline, but it's because of Mac sales. People are buying Macs. That's basically the reason why they actually disappointed. That is a surprise.
Yeah,
and it actually disappointed, Tom, with the iPhones. The iPhone sales numbers came in light, which is their bread and butter, and they are concerned and raised some flags about heading into the winter quarter. I'm not saying it's all doom and gloom. It's just that even the one stalwart definitely highlighted the moment that we're in, especially with the foreign exchange pressures. And Tesla, this is the last day it's going to be up here, so I figured I had to highlight it. It is being delisted today, Tom, after the purchase. Twitter shares are being delisted. Tesla shares, are not being delisted. Those shares lower as he comes out, as Elon Musk comes out and tries to take the helm
of Twitter.
Lisa, thank you so much. Greatly appreciate it. Your conversation to get into the weekend on fixed income. Ian Lingen now joins us, head of U.S. rate strategy, BMO Capital Markets, out of the University of Minnesota Finance Shop, which is a big deal when you look at the quality of the Minneapolis Fed as well. Ian, we got 8 ways to go here. It could be a 2-hour conversation. I'm going to go right now to the short-term trust market overnight. Swap lines of Switzerland twice now in the last number of weeks. Worries about swap lines worldwide. And the litmus paper for this is FRAOIS. We're talking about Happy Friday and all this stuff. Happy FRAOIS. What does it signal? That this short-term ratio is through the roof.
I think that the biggest issue at this moment is a dollar shortage globally. Now, we've seen the run-up in rates domestically. We've seen the run-up in rates in Europe as well, not only policy rates, but also overall yields. And as a result, what we're seeing in terms of the dollar is a unprecedented run and scarcity. And scarcity becomes problematic when we think about what's going on in Europe, in Japan. And I think that's going to be a big story.
Does it limit the degrees of freedom that the Central Bank of the United States has? If there's a dollar shortage, does it limit the choices that Jerome Powell has?
I think it's a result of the choices that Jerome Powell has made, and now we're running up against some of the natural limits. And as monetary policy goes deeper into restrictive space, each incremental hike is going to be more difficult to justify. Let's face it, the Fed has been leading the most recent push higher in global rates, and as a result, the dollar has followed suit.
How do you talk about the shortage of dollars that we hear about, the idea that just physically a lot of nations need the physical cash? How much does that pressure the Fed to really open up some lines akin to what we saw in 2020 and that sort of uncomfortable reality of trying to tighten policy while also in effect loosening in some capacities?
Well, it's interesting because there are a number of different ways in which monetary policy in terms of tightening is running up against some of the key constraints. I think another good observation in that regard is the potential for the Treasury Department to start buybacks in the long end of the curve. That seems ostensibly like QE, but in fact, it's just a market functioning move. But there's no question that that's a result of how tight policy has become and how high rates are.
Do you think that we're actually going to be doing quantitative tightening come next year in the United States?
Selling outside of what is the natural runoff at this point seems as though it should be on the table, if nothing else, certainly in mortgage space. However, that means that we're going to have to see a continued upside surprise in the inflation data, as well as a shift from signaling from the Fed.
What's the potential concern, though, in the mortgage market, given that that the rates have already climbed to above 7% for the first time going back to 2001, given the fact that you've seen already a rapid deceleration at a record pace in home sales, in even just the valuations, at least the pace of increases? What would that do in terms of creating a broader weakness?
So from the Fed's perspective, they're struggling with the fact that the maturities in the mortgage market are not keeping up with the $35 billion cap. And so if they did decide to sell mortgages outright into the market, the implications might intuitively be an increase in the mortgage treasury spread. But in fact, there's a very strong argument to be made that that's largely priced in. And if it were to come to fruition, you might actually see a compression. And I think at the end of the day, mortgage rates are going to be far more a function of what's going on in 10 and 30-year yields and the general direction of the overall economy.
What's your vision? You write an acclaimed morning note. I'm going to call it extremely dense. It's an extremely thick note. It takes forever to read the 2 pages. It's so smart. How far out can you look right now? Can you get to Q1 2023?
So in this current environment, I think that what we struggle with in trying to forecast outcomes is the same thing that the Fed struggles with. And that is not only does monetary policy impact markets with a lag, but also, given the nature of data collection, we're all largely flying blind because we know that higher real yields are going to impact the real economy. The labor market is eventually going to turn. The Fed is eventually going to realize that they have over-tightened at some stage and need to reverse course. The problem is, at this moment, given how low labor force participation is, the unemployment numbers look great. The Fed has more than enough justification to continue hiking rates. But when we look at, for example, yesterday's GDP report, final sales to domestic purchases up just 0.5%.
First thing I look for.
And that
First
is,
thing I look at every time.
as it should be. And that was problematic. It shows we're at stall speed for growth.
We're at stall speed for growth, and that limits the degrees of freedom of the Fed. Do you anticipate a shock to all the punditry that's out there, and maybe not even at the November meeting, but at the December meeting?
So we're 75, 50, 25 for the next 3 meetings. I think that's very consensus. The one way I would say that we might differ a bit is we're on board with the soft pivot language, and that being the Fed's going 75, but it's going to be spun somewhat dovishly because they do need to downshift. And so it's going to be very hard.
He's auditioning to be on surveillance.
Team step down.
I mean, he's team step down.
Team step down.
He sounds like an anchor on Bloomberg surveillance.
You can have this seat anytime.
A soft pivot.
How do you feel about a happy Friday? Happy Friday.
Happy Friday.
Yeah.
Friday.
Friday.
I don't know what he thinks of that. Ian Lingen there of BMO Capital Markets. Ian, thank you, sir.
Just brilliant.
Do you know how many hikes we've had this year?
Just brilliant.
How many hikes, Tom, from Michael Hartner and the team at Bank of America?
Yeah, it's a big number.
243
This is like worldwide, adding them all
rate
up.
hikes thus far in 22. They said that's basically one rate hike every single trading day. They go on to say, and I think this is the important part of their analysis, is that the bond market is now pivoting from inflation to recession, and that with the BOE, the RBA, the BOC policy blinking, if you want to call it that, their words, their quote, it means a Q4 bear hug, risk asset rally, but their ultimate conclusion, we say a recession shock is a new high in credit spreads and a new low in equities, and the time horizon they have for that is the Q1 of 2023. And really, Mike Wilson, Lisa, from Morgan Stanley, basically took the same time period with us, didn't he? He said Q1 23, that's when this bear market might be ending.
And how much does that have to do with earnings capitulation? We're seeing a bit of it. The implication is it's not all been baked in, that there's going to be further pain that they're going to express. The visibility just isn't there, though, for them to do it right now.
Someone wrote into us on Twitter. They want to know, I'm curious, how will we all dress for Monday's Halloween show on Bloomberg Surveillance?
Well,
how are we going to do this? I said QT t-shirts.
No,
available at all good Spirit Halloween stores.
We could practicing for Halloween.
Could do Chairman Powell, Governor Bailey, and President Lagarde. I won't say who's going to be who, but we could work that out.
I had
you
a
could do
failure
President
last
Lagarde.
year.
That might work out.
I met with Ms. Lagarde at the IIF, and I said, "Is it okay?" And I said, "I can do the beautiful gray hair thing." She said, "Oh, Tom, yes."
Keep digging. Keep digging.
I went as Harry Kane last year, and it didn't work out.
No?
There were enough
What was the
people
party?
that-
I didn't go to that party.
No, it was just trick-or-treating with afterthought. I went as Harry. This year I'm going as a swap line.
Swap line.
As a swap line.
My son is going as a whoopee cushion, so there you go. That's kind of
Is that actually a thing?
What are you going as? Come on,
Is that what he's doing?
It's too big.
No,
Don't
do that.
Don't come round to mine, because that would legit scare the hell out of me, okay? Coming up 8:30 Eastern, Lindsay Piexer of Stifel. Looking forward to that from New York City for our audience worldwide on TV and radio. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk is cleaning house at Twitter. He's completed his $44 billion acquisition of the company, and Bloomberg's learned he's gotten rid of the CEO and other major executives. Musk plans to be Twitter's chief executive for now. He also intends to do away with permanent bans on users, a category that includes former President Trump. In a new Bloomberg survey, economists predict the Fed will keep laying the groundwork for interest rates to reach 5% by next March. They expect that is likely to trigger a U.S. and global recession. Next week, economists see policymakers raising rates by 75 basis points for a fourth consecutive meeting. A new danger is being posed by climate change. That's according to U.S. Treasury Secretary Janet Yellen. She spoke to the EU's Sustainable Investment Summit today.
Last year, the Financial Stability Oversight Council, or FSOC, for the first time identified climate change as an emerging threat to the financial stability of the United States. Agencies have already taken steps to start incorporating climate-related financial risks into their activities.
Yellen also said the war in Ukraine is highlighting the risk of dependence on fossil fuels. And Jeff Bezos could see as much as $23 billion erased from his fortune after Amazon predicted a sluggish holiday quarter. If shares continue to fall, his loss would be the 5th largest one-day decline in wealth on record. That's according to the Bloomberg Billionaires Index. Now, if it holds, Bezos would be worth about $111 billion, nearly half as much of his $214 billion peak in July 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
I think
think there is ample evidence that there is lower inflation in the pipeline, but it's not in the headline figures yet, and I don't think the Fed is prepared to blink when they're barely over their neutral policy rate estimate, and inflation at a headline level is still high.
That's the pushback from Gene Tenuzzo of Columbia Threadneedle. Always great to hear from him. Here's the price action for you this Friday morning as we close out the trading week. Looking for a week of gains, but what a volatile week we've had. And what damage we've seen beneath the surface on some big tech players within the S&P, down 0.4 on the S&P 500. If you're looking for a move on Amazon this morning, we're still down, still lower on the stock in the pre-market. Apple just about holding on. Yields are higher by 7 or 8 basis points on a 10-year, trying to reclaim a 4 handle. Did that briefly a little bit earlier, Lisa. 399.78, just short of 4 right now.
It's just amazing to see some of the push-pull and how much things are fluctuating. Can we find some real stability in markets if you have this kind of rate volatility? I don't understand that.
I don't think you can.
Yeah.
How many times have we said it around this table? If you can't price the risk-free asset, how do you price risk? And pricing a risk-free asset right now, Tom's really hard.
Yeah, and the headline here is the risk-free asset is back. As Taleb says, the gravity's back, and that's what everybody's adjusting to. And it's going to be fascinating after the shock of earnings this week, good and bad, how corporations adjust on cost control. That's always the easy path, isn't it?
I said it the previous act, and I say it again, it's so strange to see Twitter and then this line next to it, acquired by a private investor.
Yes, I saw that.
So Elon Musk has closed the deal. Here are the headlines from Elon Musk. He says he'll dig into users' claims of shadow bans today, Lisa. He's responding to a complaint of Twitter's behavior. So day one and hitting the ground running over at Twitter.
You know, I'm curious about the personnel, and we've already seen the CEO leave. We've already seen a number of other chief executives leave. How much are we going to see some of the other talent stay, given the rumors of a 75% cuts that he pushed back, but still, nonetheless, how do you run a company with such turmoil and a lack of a sense of where things are going?
Tom, it's going to be fascinating to see what this guy does with this company.
It is. It's going to be
fascinating.
It's original, to say the least. Also fascinating in the election of the United States, and we will see that in 2 weeks. Before that, another rather large election, this, of course, in Brazil. It is a massively polarized Brazil. Our Sherry Ann is there in Sao Paulo, and she joins us this morning. Sherry, the distinction here of getting to an October 30 election, what will you study in the coming 2 days?
We are watching right now the poll numbers very closely because, Tom, of course, we have seen a massive underestimation of Bolsonaro's performance when it came to the first round of elections earlier this month. So now the key question is, in a country where you cannot rely on pollsters, what do you watch? Well, really, they're trying to account for no-shows because Lula tends to get hurt when abstention rates are high. His base of support really coming from low-income voters that are more likely not to show up. So we are now seeing, when it comes to Datafolha, the latest numbers, that Lula's lead has actually widened to 53%, which is higher from last week. Right. Which is really interesting because this week Bolsonaro's momentum is fading.
Is the public engaged? We've got a massive turnout in the United States for a midterm election. We all know the history of the U.S. presidential election. How much are the people of Brazil engaged?
There's a depolarization here in Brazil. And of course, when we talk about Latin American politics, we're not really necessarily talking about right and left, which of course have defined lots of elections around the country this year, but it's really about pushing back against the establishment in a way. So we have seen that engagement quite low in the first round, Tom. One of the lowest voter turnouts, about 20%, the lowest since we've seen in the 1980s. But right now, everything is getting heated. We have seen even violence last weekend with one of Bolsonaro's allies getting into a gun battle with police. So there is a lot of interest right now on the ground.
Sherry, you mentioned that it's more anti-establishment than it is normal party lines in the same kind of way. And this isn't just Brazil. We're seeing this around the world, including in the U.S. and elsewhere. How much do you see this stemming or being exacerbated by the economic place that we're all in, and Brazil as well, at a time when people do feel like they're being unfairly penalized by inflation? They're not able to keep pace. How much is that the undercurrent of this polarization for anti-establishment and trying to keep the status quo a bit more?
It has been a really interesting few months, Lisa, because as we were coming to this election, not surprisingly, President Bolsonaro tried to ramp spending, really extending those social welfare packages for low-income voters, trying to lure Lula's support base to his camp. Lula, on the other side, has been really emphasizing the economic prosperity during his 2 terms in office since 2003. Of course, the caveat was that he was enjoying really a huge commodities boom. But that has been really the undercurrent. Perhaps a silver lining in Brazil. Remember, the central bank here has been aggressively tightening, preemptively tightening. They're right now holding rates steady. So what does this mean? Perhaps a good economic mix for Brazil, where you have higher rates, you have commodities exporting industries that can really withstand perhaps the higher yields globally that we're seeing right now.
Hey, Sherry, thank you. Wonderful reporting. Sherry Ann there on the ground in Brazil. To Sherry's point, and I hate it when the Fed says front-loading, and I'm guilty of using their language too. This wasn't front-loading from the Fed. It was catch-up from the Fed.
Yeah.
The front-loaders, the people that actually went first, were in EM. And Brazil was one of them when they hiked rates in early 2021.
And they experienced the pain as a result. And you're seeing some of the social unrest as a result of some of both the policies, but more importantly, the economic backdrop. What Sherry is talking about is incredibly important because this highlights a wave of populism that will only be exacerbated by the current emotion that we're in. So how does that affect politics at a time when you've got your fiscal hands tied, you've got monetary hands tied, you've got people who are getting increasingly angry? These elections are going to matter that much more.
Have you seen where rates are in Brazil, Tom? Just south of 14%.
That's insane.
Yeah.
These are big numbers.
And the currency's actually done better than many, many others, maybe because they were early, like you say.
Speaks to that.
But, and I defer to Mr. Sassower on this, but I'm sorry, the Brazilian paper or the dollar paper in Brazil, those numbers are unsustainable. I mean, there's just no way.
Well, the dollar issue is clearly a big one, Tom. You talked about with Ian Lingen on a different topic. But the dollar issue worldwide. Lisa, it's the number one thing, I think, if you ask a central banker abroad what they want right now, if they could get a wish, yes, inflation lower, but also a part of that feature, just a weaker dollar, please.
A weaker dollar, less pressure from the Federal Reserve. This could help them at the same time at some point. And this is really the tension. I was speaking about that with Peter Scheer. He expects the dollar to be the pivot point for the Fed, because the pain outside will become unsustainable and the pressures will be quite significant. And I wonder, not only on an economic level as we see the currency headwinds to some of the companies here, but also on a political one, given that other nations are going to see these uprisings in the face of some of the pain.
Japan did nothing overnight, right? Policy unchanged.
Of course.
Yeah.
Think they can hold on for Governor Kuroda's term through the next several months?
A lot of it depends on the dollar, right? If the dollar starts to weaken or plateau, they get a reprieve.
It'd be amazing if they can hang on, Tom. Just hang on to yield curve control through this volatility.
You know, you bring it up, and I don't want to get mathy here on a happy Friday, but the bottom line is I did a 30-year study of yen dynamics, and the answer, of inflation dynamics in Japan. And 3 times before, they brought it up to a 3% inflation. John, boom. Every time it comes back down.
Did you just blend the two things?
I did.
Happy Friday.
Did you like what I did with the lingo and FRAOIS?
That was
Happy
great.
Happy Fry OIS.
Okay.
Can't do that with LIBOR.
That works on a south side. That's a great note. That's a great title for a note.
Yeah.
You should publish.
Happy FRAOIS.
You should publish that 30-year study of CPI in Japan.
Yeah.
Equity futures down 0.5%. This is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
When U.S. inflation numbers are released,
the score is inflation won, Fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority.
The ECB does have to remind itself, and remind markets, I should say, that its primary ethos is to control inflation.
We don't think that the ECB will reach restrictive territory before the start of 2023.
The global economy is looking very soft at the moment.
Inflation will probably be staying sticky and high, and companies will pass some of that through.
There is lower inflation in the pipeline, but it's not in the headline figures yet, and I don't think the Fed is prepared to blink.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome you on a Friday on radio, on television. We welcome you to double-digit inflation, no, not food inflation, in the United States. John Farrow, Germany joins Italy. This is ugly.
11 handle for CPI in Germany year over year, 11.6%. on CPI, and we've got a big turn of events in this bond market too. Yesterday, a major rally, yields lower. Today, big sell-off. Yields up at the front end of the curve, Tom, in Germany, the 2-year, up 17 basis points.
My problem with this is really, really smart people thinking really, really hard are undershooting the trend everywhere, and you wonder if that's going to be in the United States as well.
We've said it a few times. We keep talking about peak inflation, Tom. If it's in our past in America, is it still in our future in Europe? Because that inflation number is getting worse. Had this conversation yesterday about the ECB having some kind of step down. Let's talk about how difficult it is for this European Central Bank this week. 75 basis point hike, CPI in Germany with an 11 handle, and Lisa, PMI's in the 40s. That is the central banker's dilemma. Downside risk to growth, upside risk to inflation. What on earth do you do with interest rates?
Especially at a time when you did not get the worst case scenario come to fruition, or weather has been somewhat mild. You haven't seen those stockpiles of natural gas come down as much as they had feared, and still inflation is coming in harder than people expected, even with lower prices. You wonder, Tom, how this is going to play out, considering that the ECB is going to try to crack down, and we do have a lag effect.
Bring it over to the United States, John. 2 days. Halloween, I'm going as a swap line on Tuesday, November 1. ISM Manufacturing Survey is 50.0 and a 49 handle there. Again, is that tendency?
We'll see if we start to get that downturn in America, Tom. You saw those subtle hints of that in the GDP report yesterday. Many people did.
Well, okay, I take the point here that, again, Chris Lowe was outstanding on this, of a really fragile GDP report. But here this morning, bringing it over to earnings, forget about Twitter and all that theater. There's some good earnings out there, but everyone focused on big tech dealing with inflation, dealing with the dynamics of dollar.
Well, they're focused on big tech because that's where the weighting is. That's where the power is. The big weightings in a market cap weighted S&P 500. You look elsewhere at energy, Exxon, Chevron, crushing it through the year, and today on the quarter, Tom, great numbers.
What do we hear from President Biden, Lisa, today? You've talked to Anne Marie and others here. I mean, does the administration get out front here in full election panic?
Well, they probably will. They'll probably say that this is they need to really get their investments up, that it isn't as significant as it could be. But what's it actually going to do, given that we have 2 weeks? 2 weeks till the election, and, you know, it's not clear what they can do.
David Kostin with us here in a moment. Let's get through the data, John, very quickly. I'm going to do yen quickly here. Backs up off BOJ, 147.51, rounded up 148. Where is that statistic Sunday, 7 p.m.?
Did you just say bad Exxon as if Exxon was a dog's name?
Yeah.
Exxon.
Well, the president couldn't go bad Exxon.
Did you not notice
bad
that?
Exxon.
Bad Exxon.
Bad Exxon. Bad Total.
Is that what the president's
He's
going to do
come out
later?
and say bad Exxon.
Sit.
How dare you make money? Sit. And
Just stop it.
off the election, they're going to get crushed in Washington because they're going to go up there. They're going to be there, you know, and promise to sell the truth, the whole truth. And they're going to go project by project through what they're doing.
Get to Kostin before he runs away.
Do the data here before Kostin's waiting for a data
Done it
check.
already. Futures are down by about 0.5%. The bond market yields are higher by 9 basis points. They're higher in Europe. That CPI print from Germany is ugly.
David Kostin, Goldman Sachs, joins us this morning. David, can you explain to me how your world has changed from when I studied 3 to 4% FX adjustment on equities, and all of a sudden we're doing dollar adjustment of 6%, 8%, and the CFO of Apple said near 10% yesterday. How does your world change with strong dollar?
Well, the way the world changes from a fundamental point here in the United States is that 70% of the revenues of U.S. companies are actually generated domestically. So therefore, the sensitivity of companies from a corporate point of view is largely going to be focused in the technology sector, where almost 60% of their sales are overseas. So from that point of view, Tom, the translation back is really going to be focused in certain areas as opposed to broadly across the market. When you look at the sales of healthcare companies, utilities, and the telecom companies, even financials, largely domestic in nature, and therefore it's less sensitive than maybe is widely perceived. But it is definitely a concern and a focus on some of the global multinationals, tech in particular.
David, let's talk about buybacks. This came from Market Insider yesterday. Listen to these numbers. Meta spent $45 billion on buybacks last year, paying about $3.30 a share on average. Meta yesterday closed with a 97 handle. David Kostin, what on earth is going to happen with corporate buybacks in the year to come? And just walk us through, because I know you and the team at Goldman do so much work on this, the importance of buybacks as a feature of demand in this equity market.
So, Jonathan, a critical point is the fact that over the last 10 years, every year, the single biggest source of demand for U.S. shares has been corporate repurchases. So, question here is, this year, they'll be up around 5% versus a year ago. And our forecast next year is they'll probably decline by about 10%. So 10% less buybacks in 2023 than this year. That's assuming a soft landing. Jonathan, if you had a recession scenario, that's probably down 40%. That is, again, a very significant development in terms of the confidence that CEOs have in the outlook for business activity in the coming year. That does drive some of their decisions on their capital spending. I've spoken to some boards this week as they think about their uses of cash in the coming 12 months, the idea of how important capital spending is relative to research and development dollars. How do they think about the prioritization of merger and acquisition spending? But buybacks has been the default use of cash for a lot of companies, and that is likely to be receding as we look into calendar 2023, and that again has been the single biggest support function for equity prices in the last 10 years.
David, just to sort of underline this point, how much do you expect this to pull back in terms of how much stocks can gain, just simply because this massive buyer will not be there?
Well, it's a big issue when we think about the flow of funds. If you want to think about it in that context, Lisa, the idea of pension funds as countercyclical buyers would be one area of source of demand, partially offsetting some of the pulling back on the buybacks. But it's tough to basically replace that when looking at companies spending around $3.1 trillion. That's the cash spending of S&P 500 companies, $3.1 trillion. This year, probably flat in terms of overall spending for next year, and corporate buybacks roughly $1 trillion this year, and that's likely to be down probably closer to $900 billion in next year. There's really not another source of demand for shares that is going to replace the bid, if you will, from the corporate side.
David, one thing that Goldman Sachs has been out front on is that you don't think that there has been full earnings capitulation in terms of what we can expect going forward. What do you think the trigger will be to sort of throw the kitchen sink at the issue and really see the downgrades to outlook that you would like to see a bottom?
Well, just to be clear, Lisa, it's not like I would like to see them. And what do we expect to happen? I think the point you made is an excellent one. Keep the following kind of numbers in mind. Coming into the first quarter, the expectation was about plus 5% year-over-year earnings growth. Came in plus 12. Second quarter, expectation plus 6, came in plus 10. The setup coming in for the current quarter was basically plus 3. Expectation year-over-year growth, earnings plus 3%. They're basically somewhere between 1 and 2%. So there's actually a negative or surprises relative to expectations. That's right now. What's happened then looking forward in the fourth quarter? Expectations kind of at this time, before the earnings season began, was plus 7. Now it's looking at plus 5. So the idea of this cuts or a death by 1,000 cuts, that's essentially what's happening as you look into the fourth quarter, and then more importantly, as you look into calendar 2023. Our expectations right now are basically plus 3% earnings growth. So basically a modest growth, nominal dollars help sales, higher inflation, bad for margins. So you basically have a very modest level of profits. That's assuming soft landing, or basically economy continues to grow, although at below trend pace. On the other hand, if you have a recession, which more and more of the portfolio managers with whom I speak have that view, then basically you'd have earnings probably down 11%. So that's your starting point. And Lisa, the point is that currently expectations in next year is probably plus 7. So think in terms of the magnitude of diminution in terms of the cuts, probably coming from plus 7 down to potentially as low as minus 11%. And that historically has been the case coming into a recession, sort of the period 6 months ahead of recession, the earnings usually get cut by around 10%. So a lot of focus has been the impact of higher, Dom made reference earlier, the dollar, the impact of higher inflation. What does this do? Can companies, support their margins? The answer is there's downward pressure. The source of the negative surprises this quarter has been, in fact, weaker margins than was anticipated.
David Costin at Goldman. David, one of the best. Just fantastic to catch up with you, sir. Enjoy the weekend. David Costin there of Goldman Sachs. TK, what a week. It's been fascinating. We talked about the equal weight and the outperformance there, the outperformance of small caps as well this week too. The equal weight S&P up every single day this week, even with that tech carnage.
I'm going to go back. I'm as guilty of this as anyone. We are completely fixated on 20, is it indeed now 30% of market cap?
Sure.
Caterpillar. I mean, it's in CFA level 1. It's one of the 2 major accounting companies you use. Nobody talks about it.
Well, that's the point. That's why I keep bringing up the equal weight. If you strip out the muscle, the market cap weighting on the S&P 500, those big tech players, Lisa, that hasn't been bleeding this week in a major way.
This is the push-pull between people expecting the Fed to not raise rates as much. That's providing some tailwind to that, and then the others, which are getting hit by the earnings.
We should do a photo for Halloween. For
What's
radio,
the photo
this really works out. This is a number of years ago from a gentleman who works at the Cleveland Fed. And he did this to his 3 sons.
What is it?
And it's just, they're going to bring it up here. There it is. Look at them. He dressed his 3 sons up.
They all went as you.
For Halloween.
That's terrifying.
That's terrifying.
That's abuse. I bet they got a lot of candy that week, Tom.
Look at that.
They look happy, though.
Good morning to 3 cherubs.
They look happy. Are you saying they've done a bad impression? Are you saying that's a bad impression of Tom because they look happy?
What's good about it?
Lisa. So much love.
This is Bloomberg.
Good morning, Cleveland.
Gotta love that. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk has begun putting a stamp on Twitter. The world's richest person closed his $44 billion takeover of the platform and has begun firing major executives. Bloomberg's learned Musk plans to assume the role of CEO. He also plans to do away with permanent bans on users, a category that includes former President Trump. Volkswagen has cut back its sales expectations for the year. Europe's biggest car maker now sees deliveries on par with last year. VW is still being hampered by the availability of chips, and logistics remain a challenge.
We are living in challenging times with numerous global crises, and the supply chain issue is one of this. What we have shown during the last months with our financial robustness, that we will be prepared for the future.
Meanwhile, VW says it's struggling to keep up with the demand for electric vehicles. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Strong enough to stay. We will never
powers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going across the wire.
A big beat. Stock is up more than 8%. Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch? That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The big issue here, guys, is, and it's really a mess. The Fed is raising rates in a historic way into a generationally levered system based on debt to GDP. Inventories have spiked and demand is weak. That is not the formula for, wow, let's go out and buy stocks because it's about to get good.
Love catching up with Tony Dwyer. Tony Dwyer there, the Chief Market Strategist at Canaccord Genuity. Looking at the equity market right now on the S&P 500, futures down by about 0.5%. The story of the week, the story of the year, the performance of the new economy versus the performance of the old economy. Amazon is down in the pre-market by more than 13%. Chevron is up by a little more, Tom, than 2%.
Yeah, those are the changes. Can we go to Dwyer there?
Of course you can.
Who was phenomenal.
Always is.
Staying in the market, and he kept saying, until there's a recession, until there's a recession. And he's amended his tone as we get there.
Because he believes it's coming, Tom.
Yeah.
And the GDP performance yesterday, yes, the headline number might have looked okay, but beneath the surface, there were some concerns.
I just love these people that have the courage to be in the market through the thick and thin of all this as well. Right now, I don't know if I have the courage to be on Twitter. We'll have to see how that works out. I'm waiting for Elon to tweet me and block me
What do you mean?
Whatever he's going to do.
What are you worried about?
I want him to follow me.
Oh, you want Elon to follow you?
Yeah, now that he's a CEO.
And get you some more followers. Is that what it's about?
Ed Ludlow with us right now on Mr. Musk and Twitter. Ed, I want to go to a financial aspect before we get to the cultural moment. This is at 8 times sales. There's reports of 200 million plus to the executives exiting as well. Frame for our audience how absurd 8 times sales is.
Yeah, he's overpaying for this company, right? This is a $44 billion deal. Okay, there are co-investors on the equity side and there's a debt proportion. Servicing that debt is a really big concern, and there's a lot of great reporting on the Bloomberg about this. It's a 54% premium of where Twitter was valued at the beginning of the year, and they are going to have to spend anywhere from 100 million to 200 million on severance, and then the unvested equity for the C-suite, which all walked out the building last night and are not coming back. This is a stock that in its public market life trailed the S&P 500 and the NASDAQ 100 every year since it went public. So Musk kind of realizes that he's buying this with risk, but look at what he said yesterday. He put out that public statement saying, oh, actually, I realize advertising is the core of this business.
Who does he bring in to replace all these bodies going out the door?
According to sources, he brings in himself. He appoints himself. He appoints himself as chief executive officer at the interim. I reported yesterday with Kurt Wagner that he brought a small army of Tesla engineering talent into the building just off Market Street. He buddied them up with their corresponding Twitter engineering talent, sat them down and made them wade through the code which powers the Twitter platform so he can understand how the code works. This is the level of micromanagement that Musk has at Tesla and that he has at SpaceX. This isn't surprising. This is what happens every day across all his companies. He takes control, and actually the names that are working behind the scenes at SpaceX, other than Gwynne Shotwell or Drew Baglino at Tesla, they're unknown because they don't have public-facing profiles, and Musk takes not just the public-facing responsibilities of those firms, but he also micromanages on the product side too.
So I've been informed that I'm going to go as Tom Keene for Halloween, and so I have to ask unfair questions and do sort of the Tom Keene impression. So unfair question, what does this mean for Tesla that Elon Musk is going to be spending so much time over at Twitter trying to reconfigure something, and it doesn't seem like there is this sort of synergy between the two?
Yeah, throughout the week, the market, Tesla retail investors, Tesla fans, and institutionals that I spoke to were bracing for Elon Musk to sell more Tesla stock to fund the deal. That's part one. There's an element of key man risk, which the four of us have been talking about for months, that Elon Musk is distracted. But I think that when the news came out from Bloomberg that Musk would install himself as CEO, I heard from a lot of people that are concerned because they do want him to focus on Tesla, which faces supply chain challenges and also has to sort of be strategic about how it's pricing its vehicles in the face of a global slowdown. He is micromanaging and fully involved in the future of SpaceX and his bigger picture goals of getting mankind to Mars. There's a lot of concern that he can't do it all, but also that he's not able to accept, according to sources, this is a concern, his own limitations. He doesn't necessarily have the skill set to run a social media company. And so there are questions about who he'd bring in. I'm actually hearing from sources and Twitter insiders, they actually want Jack Dorsey to come back.
Interesting.
And the reason that they do is that he has a good relationship with Elon Musk, but Jack Dorsey, in the meantime, can sort of glue together the fractions within inside that building. Remember, this is a company that has 7,500 employees. Right. It's not even that many in the context of global mega-cap tech stocks that have hundreds of thousands of employees. So, you know, that's what I'm hearing on the ground, at least.
Just real quick here, what is the regulatory oversight at a time when this really is the billboard, the sort of global billboard that so many people use to get their news?
Yeah, well, I think we've already heard from Thierry Breton, right, the markets commissioner in Europe, who says, in our market, we control how Twitter flies. In other words, you know, he sent out a warning that whatever happens on a policy standpoint and how Twitter operates, it has to operate within the laws of the jurisdictions in which users use it. Musk has said that on the free speech issue. He wants to support free speech and allow the widest range of voices possible. But he's also been clear, to be fair, that if you say something, it has to be legal within the jurisdiction that you yourself as a user are operating with. But we do expect that to be a conversation, not just in Europe, but globally. And then there's the backward looking. Do regulators look at how this deal came about, how Musk first disclosed his stake and how we got to this point, how the two sides communicated with one another? There's lots of reporting out there that both the SEC and FTC are already looking at these points.
They're going to be busy, potentially. Ed, thank you. Ed Ludlow, there on the West Coast. There's the tweet from Elon Musk just moments ago. Bramo, let the good times roll over at Twitter.
Chief Twit, let the good times roll. What did he say? Free bird. Here we go with Elon Musk. And what kind of leader he'll be is unclear. What free speech means will be, once again, very much in the forefront as he talks about removing some of the bans on people like Donald Trump. And where do the moderators go?
I mean, I guess he outbid it at 8 times sales, but you just wonder why some ginormous company didn't come in and buy this up almost as a research project, but I guess they got outbid.
Well, you said it, price, right?
They get price, they got outbid.
Who wants to put that price up?
Yeah.
Elon Musk eventually himself, by all suggestions, didn't want to pay that price, but he's had to. I've had a lot of people say that Elon Musk has had success where there are engineering problems, and this isn't an engineering problem. I think that kind of forgets that he is a marketing machine.
Well said.
He's also a marketing machine, though,
yes.
Tom, and that's kind of what you need at Twitter.
Well, although there is the sort of technical issue of algorithms that could potentially weed out some of the bots and other issues that people face on Twitter.
It's funny, I just never thought this deal would close. I was
know,
so
nobody
skeptical
did. Nobody did.
The whole way when
So
it
were
came
a
to
lot
the
of people.
financing, the debt.
The shares are up so
Elon
much
Musk
this
see
year.
my DMs?
Probably, yeah. He's probably reading them right now.
You better be careful.
Boy, am I in trouble.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg Crypto.
Connection lost.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. That's not nice, Lisa.
What, I
It's
can't
technically
picture you at a
bullying.
farm?
It's not nice.
I can't-
Futures are down by 6 or 7 tenths of 1%. It's not nice, is it? I don't know why
okay.
she talked to us like that in the break. I don't get it. What's it about? Futures are down 7 tenths on the S&P. Be nice to us. Yields are up 8 basis points on a 10-year to 399.78.
Look at those data.
Can I get out of here?
Look at this data. So let's get to the ECI. The Fed talks about how important it is. The employment cost index, 1.2%, in line with the survey of 1.2. The previous read, 1.3. Let's look at personal income and personal spending. Personal income at 0.4, in line for the month of September at 0.4. Personal spending 0.6. So that's punchy relative to an estimate of 0.4. The PCE deflator year over year, 6.2%. Survey 6.3, PCE core deflator year over year, Lisa 5.1, the survey 5.2.
Yeah, so this actually is on the margins good, right? So this is actually coming in at a lower pace, and ECI coming in line is actually impressive considering the fact that the likes of Citigroup's Andrew Hollenhorst was expecting 1.3% and said that really it does highlight this wage spiral. How much do we stop hearing about that since we're not necessarily hearing about this sort of acceleration?
Hard to get a real read on how the market's responding to this in the bond market because we're seeing yields really kick higher over in Europe and we're seeing a similar move in sympathy in the United States. So Treasury yields right now as things stand at the front end up 6 basis points to 4.33 on a 2-year. Tom, just looking at the Italian move, up 20 basis points. Similar moves over in Germany. Inflation out of Germany this morning with an 11 handle.
And the duration of it,
stuff.
there's none of this transitory stuff. I'm not hearing anything transitory out of any of the countries over there. We'll touch on that in a moment. I do want to point out, John, you look at everything here, and I've got some dollar strength, and I really wonder, where's the dollar a week from now? After this dollar pullback.
You're going into the Fed decision next week. That's come quick, hasn't it, that Fed decision?
Yes, it has. And I actually looked at the data that they will get being data dependent to the inflation data, which you brought up earlier in the week. And they just get a ton of data getting out to November.
Payroll's on Friday, next Friday, and then the week after, November 10th, we get CPI again.
And a lot of, like, say with Bloomberg on radio and television this morning, 10 a.m., the Michigan statistics, which are of value. The Michigan statistics are particularly of value if you're weighted to the Midwest, as Lindsay Pieggs is out of Northwestern. And of course, with Stifel, and she's their chief economist and joins us in studio today, which is an honor from the Midwest. What's the Midwest economy like compared to people on the East Coast working in 3 zip codes? What do we get wrong in our silly focus on Manhattan?
I think we're missing the compounding level of pain that we're seeing across the country. We are seeing small businesses, we are seeing consumers very much under pressure as a result of rising costs. We're seeing businesses struggle to stay afloat. They're facing rising rental costs, rising parts costs. It's a very difficult environment, and sometimes we do focus just on the microcosm of some of these major cities that may be faring slightly better, but the rest of the country is still under an extreme amount of pain.
I'm going to rip up the script right now. We're going to get Dr. Pieggs in trouble with her general counsel at Stifel right now. Let's go political. There's an election coming up in a couple of weeks. I just mentioned food inflation of 11.2%. Does that sustain, as John Farrow talks about German inflation sustaining?
Well, I think right now the risk to inflation in the U.S. is certainly to the upside. The idea that we're going to see this welcome downward trajectory as the Fed has predicted.
So what's your x-axis on double-digit food inflation, in the next year?
Absolutely. I think carrying into 2023, I think this could absolutely be a 2024 event as well, that we're continuing to see these contagion effects in the agriculture market, in the energy sector, and this is going to make it very difficult for the Fed to get inflation back down to their 2% target. And remember, even when we look at the Bloomberg estimates across the past several years, the market is consistently underestimating the level of inflation by anywhere from 50 to 150 basis points. And so this is an ongoing theme.
Well, although some people would argue that we're also underestimating on the flip side how quickly it could come down, and that we are seeing things like used cars, we're seeing housing prices start to stabilize or even in certain places come down. We're starting to see this feeling that perhaps we're not going to get that acceleration in some of the main components that have been driving this. What do you say to them that perhaps they're missing the forest for the trees with respect to some of the other price pressures coming from wages in other areas?
Well, we are seeing demand destruction in some areas, which I do think will translate into slower cost pressures in some sectors. But at this point, when we're still talking about an unemployment rate at a 5-decade low, contributing to that upward pressure on wages, coupled with the idea that it's not just a demand side inflation equation, it's also a supply side inflation equation. And there, the Fed has very little control over these factors.
So I've been watching spending figures, and consumers are still spending. We saw that GDP print yesterday, and that surprised to the upside, consumer consumption. How much is this being driven by borrowed money, by credit cards? We're seeing debt on credit cards climb to the highest levels that they've been going back to 2019. This is kind of a perilous time to be accelerating leverage, no?
Well, to your point, consumers are still spending, but it is very clearly that second derivative decline, meaning a slower pace of still positive expenditures. We're talking about sub 2% consumption levels. That's far from impressive. But we're also seeing very temporary factors helping support the consumer. We did see lower prices at the pump over the past couple of months. We have seen consumers turn to credit cards. And while I'm certainly not advocating that consumers take on new amounts of debt, we do have quite a bit of wiggle room for consumers to expand their balance sheet. We are starting from a relatively healthy standpoint when we look at debt relative to disposable personal income. That's at a multi-decade low. So we do have additional room to continue to supplement these lower levels of spending for another month, 2, maybe longer, at which point many are optimistic there'll be additional fiscal stimulus coming down the pipeline to help those in a position of unemployment or in a position of hardship.
Next week, November 2nd, Wednesday. Can't believe it's November next week. I know. Ridiculous. Anyway, Federal Reserve meeting, Chairman Powell in the news conference. Given everything you've just said, and given the hopes of dreams of this step down that I keep hearing about, we all keep hearing about over the last week, how does he navigate that conversation, given everything you've just said?
I think he says at some point it will be appropriate to slow the pace of rate increases and assess the earlier impact of policy decisions. We're not at that point yet, but at some point that will be appropriate. That will give the committee enough wiggle room to continue at a more aggressive pace, and we do expect the Fed to maintain this aggressive pace into the end of the year and even revise higher their forecast for rates and inflation. but it also gives them enough wiggle room on the other side that should inflation surprise to the downside, they could begin to look at a more benign 50 basis point increase steps.
Let's go out 5 years. You had the honor of Robert Gordon economics at Northwestern. That book he wrote a number of years ago on the collapse of economic growth in America was gloomy, gloomy, gloomy. Is he on to something here, or can technology save the American economy out 5 years?
It's going to be a big question mark about productivity. Productivity has been languishing in this country for the better part of the past decade at about 0.5%. So when we look at the growth prospects of the U.S. economy, signs of return of productivity, I think the long-run potential is below 2%, probably around 1.8%. So without that influx of productivity, without that boost, I do think it's a more dismal long-term potential for the U.S. economy. Still positive, but certainly not robust.
Lindsay, we're going to leave it there. Fantastic to catch up with you.
Thank
Lindsay
you.
Pieksa there of Stifel on the look ahead to November 2nd, November next week. How quickly is
What are
this
you going
year
as for Halloween? Somebody emailed and said, what's Farrell going
I
as?
thought we were mixing it up. We were going to put Chairman Powell's name in a hat, President Lagarde's name in a hat. Governor Bailey,
I'm going as a
you
swap
don't get
line.
to choose. And then you pick a name from a hat, and that's who you get to dress up as.
Fabulous. I'm completely
I'm
a fan.
sure your local Spirit Halloween will stock those outfits.
I'm sure.
The President Lagarde suit.
Lindsay Piegza with Michael Ferroli at JP Morgan. These are stunning run rates for the American economy. Nobody, including any of the politicians, are set up for a sub 2% run rate.
I was just looking at core PCE for next year. So ECFC, the function on the Bloomberg, because Lindsay mentioned some of the estimates out there. 5% for 22, 3.4% for 23, and 2024. The median estimate right now, Lisa, is 2.3%. If you want to look at CPI, 8% for 22, 4.1 for 23, 2024, 2.5%. That's the glide path, the consensus view for the glide path for inflation through the next couple of years.
I'm wondering what Diane Swonk would call that. I'm suspecting that she
her word
might,
is fanciful, isn't it?
Yeah, fanciful. I think that she might have an impression about this as well. How do we get there that quickly, given some of the pressures? And the theme of the morning, as you put out, about the old economy versus the new economy, and the old economy waging revenge on the new economy of tech, right? The oil, the gas, that's not going away. So how much is that going to be a persistent pressure?
Well, just to reaffirm how bad I am at this, if you'd said to me 12 months ago that we'd still had COVID-0 in China, I would not have guessed that we could have this sustainable rally that we've had in the commodity market. Of course, Ukraine and the war with Russia has been a big, big problem in that. I get it. But the fact that we have had this massive commodity boom without China online, can you imagine how much worse things would be if we didn't have COVID-0 in China?
You started this by saying how bad I am at this. Who's good at that? At having a crystal, being able to predict any of this stuff? Nobody can.
Thank you for protecting me. I appreciate it.
But it's like, no, but that's part of what's underpinning the incredible volatility.
This cycles move really quickly, Bramo. I totally agree, and it makes, I think, any kind of forecast next year, Tom, the size of the asterisk next to that forecast in every single annual outlook that comes out in the next month or so, it's got to be huge.
I have a fond memory of the certitude of 3-year forecasts of economists gone. 2-year gone. 1 year maybe.
2 weeks.
No, and I'm going to go back to the ECB headlines yesterday, folks. They come out in a stream. The acclaimed Bloomberg headlines 40, 50 at a time, and none of them were time-stamped like Draghi. None of them.
What they want, Tom, is to leave forward guidance in the past. What they want is some kind of meeting-by-meeting optionality. The problem they have in places like Europe, Lisa, is that inflation's still running away. Is that really the time to open the door to kind of two-way risk to be introduced back into the market? Because if you offer me one-way risk and you just say keep hiking, that keeps financial conditions tight. If you turn to two-way risk, that doesn't keep me nimble. I'm just thinking, oh, you sound more dovish. Financial conditions ease.
Yeah.
And that's what's taken place over the last month.
Until we get the CPI report after the election. And then all of a sudden, perhaps the two-way risk becomes more heavily weighted one side, depending on what that shows.
We're at the mercy of that.
Yeah, we're at the mercy of the data.
The next couple of weeks. This was fun, guys. Thank you.
You're leaving?
Gonna go. Yeah, as I always do. To the next show.
Fun.
Next hour is going to be a ton of fun. Hugh Hendry has made the trip over from St. Bart's, lucky him, to New York City. The founder and former CIO of Eclectica Asset Management.
Super fun.
It's going to be awesome. 9:30 Eastern Time, coming up from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk is cleaning house at Twitter. He's completed his $44 billion acquisition of the company, and Bloomberg's learned he's gotten rid of the CEO and other major executives. Musk plans to be Twitter's chief executive for now. He also intends to do away with permanent bans on users, a category that includes former President Trump. In a new Bloomberg survey, economists predict the Fed will keep laying the groundwork for interest rates to reach 5% by next March. They expect that to likely trigger a U.S. and global recession. Next week, economists see policymakers raising rates by 75 basis points for a fourth consecutive meeting. British Prime Minister Rishi Sunak is taking no option off the table as he tries to plug a $41 billion budget shortfall. That includes windfall taxes on banks. We asked the CEO of the UK's NatWest Group about that.
The UK banking sector is already very well taxed. We pay two taxes, the bank levy, which is already in place. So we do contribute from that perspective. We're highly taxed and more taxed than other sectors and the financial sector globally. So, but it's clearly something that the government may look at.
An announcement on taxes is likely to come in the government's so-called autumn statement on November 17th. And Porsche's surging income failed to impress investors. Profits soared 41% at the luxury car maker the first 9 months of the year, partly due to the exchange rate effects. But Porsche didn't raise its full-year guidance. That suggests the current quarter may be more challenging. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is is I try to create serendipity.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
There's a lot of pressure for companies who are in China, well-established companies like Citi, like JP Morgan, as financials, who need to have a presence because that's the nature of their global business. And if they start getting too pessimistic about China, I think one of the things that's going to happen is that they're going to start getting cut out. And in order to keep their business models going, they have to be cheerleaders for the administration.
Bill Lee, the Milken Institute, absolutely brilliant on the changes in China here coming off the Party Congress a week ago. Always good to speak to the gentleman from the Milken Institute. This is a joy. He is out of Punahou in the esteemed poli-sci program at Williams College. He did something with an internet company years ago called America Online, and then he was supposed to leave the cushy life. Steve Case chose not to do that. And more than anyone I know in technology, he has gone out and said, from sea to shining sea, how do we do tech? The Rise of the Rest is a second effort at this. It is a short, terse book. I can't say enough about it, rated by the FT in their beauty list this year. Steve Case joins us now on what's going on in Pittsburgh, what's going on in Detroit. Steve, you begin the book with Shinola in Detroit, Michigan. I get Austin, I get Nashville, I get Fargo. Okay, why is Detroit the rise of the rest?
Well, the whole book is around dozens of cities, but I start off with Detroit because it's such an amazing story. 100 years ago, Detroit was sort of the Silicon Valley of its time when the car was the technology of the day. Everybody wanted to be part of the car revolution. People moved to Detroit to be part of that. It was going gangbusters for several decades, and then lost about half its population. And then the year before we came with our Rise the Rest bus, the city of Detroit went bankrupt. So it was the top city, then it was really struggling, and now it's really fighting its way back. You mentioned Shinola way back. We also backed another company called StockX. Neither of those companies existed 10 years ago. Both of them now have more than 1,000 employees in Detroit and are creating a new sense of possibility in Detroit. And that's really the story all across the country, which is why I decided to write the book, to tell the stories of these entrepreneurs building companies in these cities that are being renewed because of the work of new companies.
Is big tech helping in investment in Sioux Falls?
Well, has been more of a backlash, as you know, against big tech. That does create some opportunities for some entrepreneurs. Even, frankly, this difficult economy, you've already seen some big companies cut back on some of their initiatives that were kind of long-term growth initiatives. That creates an opening for entrepreneurs. And so I believe this next 5 or 10 years really could be great. We just need to focus on entrepreneurs everywhere, not just in a few places. And for the last decade, 75% of venture capital has gone to just 3 states. California, New York, and Massachusetts, 75%. So the other 47 states are fighting over 25%. The whole idea of Rise the Rest is to back those entrepreneurs. They're going to be very successful investments, as well as having a very powerful impact in terms of creating jobs and economic vitality in these communities, many of which have felt left out and left behind by this last wave of innovation.
What about the next couple of years, considering that there was a lot of ample venture capital available over the past 5 years? Going forward, a lot less is available. A lot of people are pulling back. There isn't the same kind of free money being thrown in terms of IPOs, and a lot less acceptance to highfalutin tech ideas. What do you think that will do to the pace of development?
Well, it might make it a little more difficult in Silicon Valley, but it actually likely will help in terms of the Rise of the Rest. And some of that is because it's always been more difficult for the entrepreneurs in these rising cities to get venture capital. Valuations have tended to be lower. The entrepreneurs have tended to be more scrappier, more bootstrappy, more capital efficient. So this change in the market where some of the high flyers in places like Silicon Valley are seeing a big reset, we're not seeing the same kind of reset in these Rise of the Rest cities. So I think that bodes well if we continue to make sure venture capital is everywhere. One great statistic in the book is over the last decade, 1,400 new regional venture capital firms have started up out in these Rise of the Rest cities. So that really bodes well for this next chapter.
I can't let you go without having some comment on Twitter going private and Elon Musk being at the helm of this. What's your view in how the view into entrepreneurs changes as it really becomes the mouthpiece, particularly even in a private way, the mouthpiece for individuals and politicians alike?
Well, I'm a big fan of Twitter. Was one of the early users, and certainly think Elon's one of the most creative entrepreneurs we've seen in this era. So don't want to bet against him. I think he does have some challenges, a little bit like the dog that caught the car, and it's a little bit now what. And I know he wants to make some moves around making it more of a town square, but I think he'll need to be careful in terms of making sure he doesn't lose users, doesn't lose advertisers, doesn't trigger more regulation. So really the first day of a new day for Twitter. I hope it goes well.
Steve, what should big tech do with a 10-year strategic plan? The massive cash buildup, selected companies with massive share buyback. They plan, the massive cash buildup, selected companies with massive share buyback. They literally, it seems, don't have the imagination of what to do with the profit. Where should they be 10 years from now?
Well, obviously, some of these companies have had enormous success over the last decade, as you've said, and that gives them a lot of flexibility. But I think the market is saying, including with Facebook, while you need to lean in the future, you need to invest in things like the metaverse, you need to do it in a balanced way. I think you'll see more of that, more of the pressure from Wall Street around companies in terms of their investment strategies. As I said earlier, that actually creates an opportunity for entrepreneurs who can be disruptive. It's been hard to disrupt big tech in the last decade. It may get easier in the coming years.
And quickly, Lisa, here, there's the fall of selected places, like the struggles of Chicago and San Francisco.
Right, as you get sort of this diversification of sources of entrepreneurship. San Francisco in particular, very much front and focus. This just crossing. Paul Pelosi, the husband of Nancy Pelosi, House Speaker, was violently assaulted early today, following a break-in at the couple's San Francisco home. This just coming out. Steve, do you think that San Francisco can recover from the exodus, the work from home trends, some of the feeling that it's been having for a while that it might be very much in the downtrend?
Well, San Francisco is still a great city. Silicon Valley is still a great place. It will still be the leader of the pack. When we talk about the rise of the rest, we're not predicting the decline of Silicon Valley. We're just the rise of other cities. But I do think you're starting to see a dispersion of talent. The people who felt they had to be in Silicon Valley now feel they have flexibility in other places. Venture capitalists that were only investing in Silicon Valley now are investing in other places. And that's why I wrote this book, to inspire the next generation of entrepreneurs and the investors to back them in cities like Baltimore, Detroit, Minneapolis, Denver, Nashville, all over the country that are really emerging as great startup hubs.
Folks, I'm not going to mince words. Bloomberg surveillance is about this nation. It's not just about New York City and maybe San Francisco and name some other things. Nobody has done more coast to coast than Steve Case on expansion of this nation in innovation and technology. 240 pages, the rise of the rest, Steve Case, with an update on his work of the last decade. Steve Case, thank you. Lisa, we've got to talk here about this. I mean, this goes back to Lindsay Pieggs at Chicago, talking about the exodus of Chicago off the mic here recently. Here's another shock out of San Francisco.
Well, and how much does this really speak to some of the main voter issues, which is crime, which is sort of the quality of life, and how much can this really become a theme? And you see Republicans trying to be out front on this. How do Democrats try to get the upper hand? It sort of is interesting timing, especially now that we've got fewer than 2 weeks to the election, Tom.
Yeah, it's there, and it's perfect timing to have Steve Case on with us as he talks about some of these burgeoning cities. We have a burgeoning market, futures at -19. The VIX, a good week for the VIX from that 30 level, coming in 27.10 on the yields, as John Farrell mentions earlier, up 12 basis points, back up 4% on the 10-year, 4.04%. This is Bloomberg. Good morning.
U.S. inflation numbers are released.
The score is inflation won, Fed nothing today.
Bloomberg brings you crucial data at terminal speed.
Core CPI in America, 40-year high.
Yields are absolutely flying.
Equities down and down hard.
It's ugly.
And instant expert analysis.
What is the makeup of this inflation?
We are watching the underlying fundamentals.
Will they go 100 basis points?
The downshift just keeps getting pushed out. Now it looks like we're going into extra innings.
Nobody covers the economy like Bloomberg, your global business authority.
What a week it's been. We're almost there. Live from New York City this morning. Good morning, good morning. Equity futures negative 0.4% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, the tech wreck rerun.
There's clearly disappointment in the market.
If you take the 5 sort of mega cap tech companies today,
whether it's Amazon, whether it's Microsoft,
Meta, Apple, Amazon,
they have all missed in terms of either numbers or expectations.
All of a sudden the demand is slowing.
Their earnings and their growth is slowing.
The impacts of the dollar are absolutely massive.
Big tech is not immune from that.
We did see a blowout in costs.
They've invested a lot in CapEx.
Multiples clearly are still not cheap enough to justify being able to absorb some of these earnings hits.
You need to have investors reset expectations.
We've been so used to blowout earnings from most of these tech companies.
This quarter in particular is proven to be a watershed moment for big tech.
What a week for the second time. Laurie Calvasini joining us now from RPC alongside Morgan Stanley's Sri Sankaran. Laurie, great to have you with us. Sri, to you as well. Laurie, first question. Looking at earnings, and I know you look at a couple of things right now. In fact, I think it's about 3 or 4. Consumer resilience, the character of the inflation story, labor and supply. What are you learning from those 4 things?
So look, I think as we go through reporting season as a whole, it does feel like companies are starting to talk a little bit about labor getting a little bit easier. We're also obviously seeing some companies, particularly in the tech space, talk about slowing down hiring or starting to actually lay some people off. So we do think the labor backdrop is getting better. I would say on the demand side and consumer resilience, the banks were singing a very strong song of consumer resilience early on. I think as we've gotten deeper into reporting season, we are starting to see some additional cracks, if you want to call them that. But in general, I think things are holding up reasonably well. But there are clearly some winners and some losers on that front where things are holding up better than they are for certain companies than other. And the market is being discriminating here, and rightfully so.
In a major way, too, because there's been massive cracks in tech, Laurie. Microsoft earlier this week, after earnings down almost 8%, Alphabet down 9%. Amazon on my screen going into the opening bow down about 13, 14 percentage points. Laurie, interesting to me that we've seen outperformance in the small caps in a big way on the Russell versus, say, the NASDAQ this week, that we've seen the equal weight S&P 500 just show that the damage hasn't spread beyond those single-name tech stories, the likes of Alphabet, Microsoft, Amazon. What do you make of all of that?
I think the word rotation is what's coming to mind, John. I mean, we've been watching the small-large trade very closely. It's been stuck in a trading range since January of this year after massive underperformance last year. And if you look really hard at the chart on R2 versus S&P, you can feel like it's actually really starting to break out this past week or so. And I think that's simply because, John, we got the pain out of the way very, very early on in the small cap space. I think the market recognizes that. There's less international, less Europe baked into the small cap space as opposed to, say, the big cap growth, big cap, mega cap tech stocks. And the market is starting to move away from areas where there's still risk to be priced in and moving into the areas where a lot of these risks have already been baked in. And that is what is supposed to happen when you make bottoms in the middle of a recession.
Laurie, is that a story you want to stick with into year end?
I think so. Look, John, I think it's always, I've done this a long time, been a strategist for more than 20 years, and December is always unpredictable. There are always wild things that can happen. I'll tell you one thing I have thought about a little bit the past few days. The average move, if you look in a midterm election year, that rally into year end is about 7% on average. Now, some years it can be a lot more. In 2002, it was over 20%. but we have kind of done the average in here. So, we're right at my target for year end. I think it's interesting. The move that we've already had has been pretty strong. Now we're starting to counter some turbulence. But in general, I think you set up for choppy conditions at least through the first quarter of next year.
Sri, I caught up with your colleague, a good friend of this program, Mike Wilson, over at Morgan Stanley earlier on this week. And he talked about maybe that rally continuing into year end. Just as a team, Sri, you seem to be much more constructive on the near term in this market than perhaps going into early next year. Why is that, Sri?
So, as you spoke with Mike earlier, the thought process here is that some of this earnings capitulation, particularly with respect to the guidance into next year, i.e. the 2023 numbers being revised lower, Mike's thought process here is that that can take a little longer than what we had initially penciled in. So it's not like the third quarter numbers per se would just be the quarter of capitulation, so to speak, on these numbers. So that's one aspect of it. The other aspect of it comes from the rates volatility side of the equation. Our thinking here is that at least over the kind of, call it the next couple of months, you could enter more of a consolidation phase with respect to bond yields. It's this combination of a more protracted downward revision with respect to earnings and some bit of respite from the rates volatility near term. That's kind of what's driving this tactical thinking. But the medium term and the longer term narrative, as you very well know, hasn't really changed. Still cautious on how this cycle is evolving.
Sri, where does that leave the credit spread story? Because you and I have gone back and forth on this. If you look at overall yields, look at price, look at the damage done to credit, it's pretty big. If you look at spreads, where spreads are right now on high yield, in and around 500 basis points, it doesn't scream recession. That's an ongoing conversation for you, for others too, Sri. Where are you and the team on that now?
Yeah, I think that's been like a very interesting aspect of how the credit markets evolve, right? So much as we speak about earnings capitulation, what's also clear is that while the credit markets kind of are penciling in more stresses, it doesn't speak, when you look at the spread measure, it doesn't speak to any kind of very imminent recession fear, so to speak. But part of our thinking here is that a twofold. One is we need to take into account the nature of the quality of the market, particularly we look at the high yield space. It is much better. It is a low cash price index that does speak to some of the kind of spread related overshoot being more modest this time around. So we shouldn't be holding the high yield market to kind of test the 800, 850 basis points, which we typically see as a recession threshold. I don't think that that's likely to happen this time around, particularly if the recession is mild. But the other side of the equation is also that when we look at the portion of the very low quality high yield space, there is a sizable portion of the market that's already trading at distressed levels, and particularly look at cash prices. I mean, we're saying roughly 50 billion is trading at the cusp of like 50 cash price. I mean, these are interesting levels for some of the distressed players. So that's why rather than just staying in the up in quality, focus on the double B low duration pockets, we're advocating a bit more of a barbelling trade. So look at the very low cash price distressed credits, which could start to perform if this whole cycle plays out a bit longer. But thought process here, distress plays out over a longer time frame this time around.
Sri, you talked about the improving quality of the index, and many people have echoed that view as well. We just haven't had that much supply in high yield either, and I know that's been a factor, a supportive factor behind that index as well. The maturity wall, Sri, it's not on the horizon. That's what I keep being told by so many people in your world, that the maturity wall for many of these companies is not on the horizon. I know you've given this some thought recently, your whole team is. When you look at certain companies, where do you find capital structures that just aren't built for this era of higher funding costs?
To be fair, I would say that we have to look at the leverage loan complex on that front. It's not been like a very popular view among certain segments, but I would say that when we think about over-leveraged capital structures, which have been optimized for lower for longer spreads and lower for longer yields, and kind of looking at, let's say, the coverage ratios, which are going to be much more sensitive to a higher rates regime, not pushing higher, but effectively rates staying at these levels for longer, then the leverage loan complex is what comes to mind. And that's where we're watching out for some of the cracks to show up if we're staying in this higher for longer rates regime into an earnings scenario, which is kind of modest, not necessarily dramatically lower, but flat earnings and higher rates for longer starts to break some of these floating rate oriented, over leveraged, more recent LBO capital structure, so to speak. But there again, we don't want to frame this as an imminent spike in defaults. What we're more concerned about is a gradual deterioration of the fundamentals, which translates into downgrades. And going into the back half of next year, we would be looking at maturity walls, which are more imminent than what we're looking at now. And if this setup continues into the back half of next year, that's when the problems come to a head.
Let's talk about the earnings story right now. Equity futures almost unchanged on the S&P 500. Kaylee, I guess it's simple. The old economy looks good. The new economy, not so much.
Yeah, especially in the form of Amazon, which is just taking an absolute pounding in pre-market trading, down about 13% after warning that growth in the holiday quarter in terms of revenue growth is going to be its slowest on record. Investors clearly do not like that. What is interesting is Apple also warned of a slow holiday period. They also missed when it came to iPhone and services revenue, but because overall they beat on the top and bottom line, they aren't getting super rewarded, but they also aren't getting beaten down. Apple's only up about 0.4%. And Intel and Pinterest, which Intel surprised on cost cutting, Pinterest surprising because it's actually faring better than a lot of other social media companies, is getting a very sweet reward, up about 10%. And this really just speaks to the pattern this earnings season. If you miss, you are punished harshly. If you don't, it's pretty sweet. And of course, for big tech in particular, it has been the punish harshly element of that. Amazon, Microsoft, Alphabet, Meta, all together this week will have seen about $500 billion wiped off their collective market cap. It's been absolute carnage. But on the flip side, those companies that have beaten have actually gotten decent rewards. And Goldman says a measure tracking how far stocks are moving in different directions on earnings days had surged to the highest since 2013. And the moves themselves have been quite large. Goldman says the average S&P stock has moved about 4.7% in either direction after posting its results. Back to the big tech story, though, the issue here really is that these players make up such a huge portion of the equity market. So where they go, the S&P tends to follow. That is why the market-weighted S&P 500, in which those names carry a heavier weight, is underperforming that of the equal-weight S&P, in which every stock is given the same weighting of 0.2%. So basically, John, heavyweights aside, the rest of the S&P isn't looking so bad.
Yeah, I agree with you. The equal weight has been the story of the week. Kelly Lyons there, breaking it down for you. Laurie, let's talk about this. The old economy, the energy names, earnings look great. The new economy, tech names, earnings look bad. When Sri and others talk about capitulation on the earnings story in Q1, what do you think capitulation looks like?
Well, I do wonder if we're starting to get some of that capitulation in the tech names right now. I mean, we know that in the broader TIMT space, earnings sentiment was already pretty lousy coming into this, and it somehow has managed to get even worse. But I think when we talk about earnings capitulation, John, what we really think about is when do revisions stop going down broadly for the S&P 500? My guess is, and this has been my view for some time, is that there's just no way we're going to get that across the broader market until the first quarter of next year. And as I've been going through transcripts this week and last week's, John, there have been a lot of companies that are just flat out saying to the sell-side analysts in Q&A, we are not going to talk about 2023 right now. Come and check back with us in February. They are being very, very clear on this point. And look, sell-side analysts, I love them, but they don't tend to take their numbers down until companies adjust their guidance. And that is just a reality that we all have to realize. And so I think we're not going to go through this process really until February and March. And typically, you know, you can see stocks put in a bottom 3 to 6 months before earnings revisions turn positive again. So it is possible for the market to bottom now. But to really kind of get out of this rut, to get out of this hole and really break out, I do think we need to get those earnings estimates adjusted. And we got a few more months to wait on that, unfortunately.
Laurie, going to stick with us. Laurie Calvasina there alongside Sri Sankaran. Right now, futures basically unchanged. Amazon in the pre-market down by 13%. Laurie talked about the analyst. I won't pick on anyone in particular. I did take a snapshot of the analyst recommendations going into that Amazon print. We had 55 buys, 2 holds, and just 1 sell. That stock's down 13%. Coming up, President Biden praising the state of the U.S. economy.
The GDP results came out, and the economy, in fact, is growing. In fact, the economy grew at 2.6% rate last quarter.
There is some pushback to that conversation up next.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Even though my Republican friends in Congress seem to be hoping for a recession, the GDP results came out and the economy, in fact, is growing. In fact, the economy grew at 2.6% rate last quarter. And although it may not feel like it for everyone, people's incomes went up last quarter more than inflation went up.
Third quarter GDP giving President Biden an 11th hour win. This is another Democratic lawmaker takes aim at the Federal Reserve. Senator John Hickenlooper writing in a letter to Chairman Powell the following: high inflation necessitates a response, but the concern is the Fed is doing too much too quickly. I urge the Fed to pause. The growing calls from Capitol Hill to hit the brakes coming just days before the FOMC is set to meet next week. Joining us now in DC is Anne-Marie. AMH, before we even talk about any of this stuff, let's get to the breaking news of about 20 minutes ago. What's the update?
So we do know, Jonathan, from a spokesperson from Speaker Pelosi's office that there was an individual who broke into her home. We don't know a lot, so let me just read you a bit of this statement. Early this morning, an assailant broke into Pelosi's residence in San Francisco and violently assaulted her husband, Mr. Pelosi. That's Paul Pelosi. He's taken to the hospital. We should note the speaker was not at the home. The biggest issue right now, Jonathan, is you're going to hear a lot of people calling whether or not this was crime-induced, whether or not this was a politically motivated attack. What we do know is that the individual is in custody right now, and, quote, the motivation for the attack is under investigation. And so at this moment, that's all I can really tell you.
And if we get any updates, I imagine you'll bring them to us. We wish the best, of course, to Paul Pelosi. Yeah. A difficult time for that family. AMH, I guess we need to talk about also the nature of the debates around the midterms within 2 weeks now.
Yeah, we are within 2 weeks. So the nature of the debates, Jonathan, we've seen them in full focus, whether or not it's been actually on debate stages between senators or also what is going on in terms of the polls. And the leading issues is really, number one, the economy and inflation. And then, of course, for the progressives and the left, it's really things like abortion. And the right, it's things like crime and homelessness. But if we focus on the top issue, and that's the economy, and what I know you're eager to talk about, is this growing chorus within the Democratic Party putting pressure on the Fed. And as they begin to meet next week, and everyone is poised and expecting the 75 basis points, another rate hike, they are saying take a pause. And the latest was Senator Hickenlooper, and this, of course, comes on the back of Senator Sherrod Brown earlier this week sending a letter to Jay Powell. And his point is take a pause now because the economy needs to absorb these rate rises, and they should see how the economy is faring before they do anything else. They're very worried about the fact that as the Fed tries to bring down inflation, which of course they want to see, they also do not want them to make a mistake and potentially cause an unemployment crisis.
AMH, just quickly, final word, Anne-Marie. Any pushback against these oil earnings as yet this morning in D.C.?
Not yet this morning, but yesterday the president made it very clear when Shell came out with these record profits, talking about the fact that and not only was these profits sky high, but that they were dividends, and instead of putting the money to consumers and helping them at the pump, they're shelling out dividends to shareholders. The president, when he looks at these Exxon earnings, Jonathan, I imagine the Democrats are going to use this to once again attack the oil industry. Exxon out with just gigantic numbers, the biggest profit they've
Huge.
ever had in 152 years.
MH, great reporting, tremendous as always. Stay close, we'll catch up a little bit later. Equity futures right now on the S&P, negative about 0.1%. Sri Sankaran, you've heard the pushback from Senator Sanders, from Senator Warren, from Sherrod Brown of the Senate Banking Committee, and then another one overnight. And I imagine we'll get another one and another one. Sri, does this make a difference, the smallest of difference to what this Fed needs to do?
I mean, I don't think that the logic is lost on the Fed either, right? So, I mean, there are voices inside the Fed which are also expressing a similar opinion, whether it's going to be pause now or pause 125 basis points hikes later. That's the key debate. Our thesis here is still that we get the 75 basis points in November, i.e. next week, and another 50 basis points, after which there's the stronger case for holding pattern there. So, I mean, for us, it's more about a few more hikes and then the debate gets real. But for now, I do think that the logic is kind of justified. All the variable lags with respect to the growth side of the equation, that is very much something which is worth debating. And that's kind of also being debated at the Fed.
I keep hearing step down. Laurie, can you tell me whether a step down in hikes from 75 to 50, 25, whether that deceleration is actually bullish?
I think that it may be good enough for the moment, John. I think that investors really don't want a repeat of 2018, where it seems like the Fed was tone deaf on autopilot and just not really paying attention to reality. And I think that would just, I think for purposes of where we are now and given the sort of healing we've seen, around those June lows, those October lows, I think it could be enough in the short term, but I think the onus will then be to see a continued de-escalation in rhetoric.
You know what Citi had to say over at Citi, Andrew Hollenhorst? He said this: if anything, we see hawkish risk as officials will look to avoid a re-loosening of financial conditions. Laurie, how do you think about that? That was really the trade of the summer, that if financial conditions ease too much, ultimately there was a cap there because this Fed had to lean back into it. Does the Fed have to lean back into this?
Well, look, I mean, maybe that's the silver lining of what's been going on with tech earnings, right? Is that, well, you're seeing a lot of healing, a lot of rotation, a lot of kind of sigh of relief on, the industrial sector per se. Tech, the wreck there is keeping a lid on things. And so perhaps that is the good news for now, is that the Fed can sort of, not have to do all the talking and let earnings do some of the work for it.
Sri, what do you make of that? And I know Ellen Zettner makes the call over at Morgan Stanley, and she's looking for that step down. You conveyed that to us just moments ago. But what happens if the market ribs on the expectation that we get a step down? Does that mean they can't deliver that step down? I mean, this sounds ridiculous as I just speak about it, but what does it all mean?
Yeah, I mean, that's going to be a tricky one in terms of the market kind of takes too much comfort from that step down. I mean, to be honest, I feel like for the credit markets, at least from the lens of the credit markets, what we're really more focused on is how long this rates regime lasts. It's not about where the terminal rates end up. That will matter, of course. But the bigger issue for corporates is going to be, as they're coming up against a stronger maturity wall into next year, where do rates or the funding yields start to give? And therefore, it feels like in the near term, you could see that push higher with respect to rates being tolerated. But eventually, the step down has to come. So I don't see that as being like a massive positive for credits, that you do see that step down with respect to from 75 to 50. We think that's just natural.
Yeah.
The question mark is going to be, when do we enter an easing cycle, and whether it's a full easing cycle or not.
Neil Dutter of Renaissance Macro said the same thing. This isn't a story. It's implicit in the dot plot right now. To your point, it's how long we stay up there and whether we get to that tension point, that bite point you talked about, Sri, later on in 2023. Laurie, to you, thank you, as always. To Sri Sankaran, thank you very much, sir. This from Michael Hartnett of Bank of America in the Flow Show, puts out that note every single Friday. This is what he had to say about the ultimate lows. We say recession shock equals new highs for credit spreads, new lows for stocks in Q1. In line basically with what Mike Wilson, Sri's partner over at Morgan Stanley, is talking about in the research team. They also talked about this. Look at that first line, 243 rate hikes so far in 2022. One rate hike for almost every single trading day this year. Just unreal. Coming up on this program, the morning calls, and later, disappointing tech earnings snapping the rally. We get the view from Wedbush's Dan Ives, plus a conversation you do not want to miss. Hugh Hendry right here in New York City.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
About 5 minutes away from the opening bell, equity futures unchanged on the S&P. Big move in yields in the bond market off the back of resilient data in America and ugly inflation data out of Europe. That's the price action. Let's get you some morning calls. First up, Deutsche Bank downgrading Caterpillar to hold, expecting further upside to be limited after quarterly results. Barclays upgraded Intel to equal weight, predicting shares are nearing a bottom after announcing its cost-cutting plans. Edward Jones downgrading Meta to hold after earnings, expecting macro headwinds and rising expenses to continue weighing on growth. That stock trying to bounce back by just 1.8%. Coming up, Apple looking to avoid the tech rout, gripping markets throughout this week. We'll catch up with Den Ives of Wedbush, who says Tim Cook is navigating Cupertino through an economic storm, and we'll catch up with Hugh Hendry on that economic storm. All of that around the opening bell next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Seconds away from the opening bow this morning. Good morning to you. Equity futures look like this on the S&P, essentially unchanged on the S&P 500. On the Nasdaq, lighter, softer, negative on the week. On the session, we're down about 0.2%. The tech rate, the carnage, pretty clear for everyone to see. First it was Alphabet and Microsoft, then it was Meta, it's Amazon this morning. Let's the opening bow, switch on the board and get to the bond market. Yields look like this on treasuries. 10-year yields higher by 8 or 9 basis points on a 10-year, just north of 4%. Euro dollar, not doing much, 99.69, but look at the bond market out of Germany. Bunds, ugly, yields higher, an 11 handle on CPI. In the commodity market, crude 87.85, down by 1.4%. We'll talk about the winners, Exxon, Chevron, with Abby a little bit later this hour. For tech, it's a tale of two earnings. Apple dodging the tech route. Amazon delivering a warning, telling investors to brace for the slowest holiday quarter growth in the company's history. Ed trying to stay on top of all of this and more. Morning, Ed.
Yeah, good morning, Jonathan. I think the street points to Apple's top and bottom line beat in the quarter, despite weakness in pockets like iPhone sales and iPad, and says this is evidence of resilience, right? Given the week that we've had, they'll take what they can get at this point, though I would say that Luca Maestri, the CFO of Apple, did caution about how the final 3 months of this year looks, and there's no immunity for Apple from the currency headwinds that have played out throughout earnings season. Amazon, a completely different story. We're down 10.4% at the open here. Biggest drop since April. I'm just looking at my Bloomberg terminal. The stock now at its lowest level since April of 2020. Companies in this earnings season have lived or died by the forecast they've given for this current period. Let's be honest about it. And an estimate of $140 to $148 billion of sales in the final 3 months of this year, the holiday quarter where Amazon traditionally books almost a third of its annual revenue, was not what the street was looking for. They were looking for $155 billion plus. And there's actually a long list of problems for Amazon here, right, John? It's not just the currency headwind, which hit them to the tune of $900 million in the quarter just gone. It's the narrative that this is going to continue. This is a company that's been trading at 40 times forward earnings, and where for the 5th consecutive quarter, expenses have outpaced the growth in revenue, and that's a real concern from the street. What's more is that the narrative was supposed to have changed. Andy Jassy is supposed to be more focused on the bottom line and moving Amazon away from those pandemic-era investments that it's made towards being sort of a greater driver of growth. And those units in the past quarters that have come to the rescue, I'm talking about AWS and advertising, also showed softness. But yeah, Apple, really interesting because they'd reacted proactively to that stronger dollar by raising prices in services. Services was also a pocket of weakness as well. So a mixed bag, but you look at how the market's doing. We're up 0.3% on the NASDAQ 100. You try and digest the week that was, John.
Just unreal. Just a final word from you, Ed. There's one stock we won't be talking about anymore. It's Twitter. What's happening over there this morning?
Yeah, look, I'm hearing actually there's a lot of people that are unhappy in the workforce. That's not surprising. I'm hearing that they're bracing for more layoffs before we are supposed to hear from Elon Musk speak. Remember, I reported that sources were told Musk will address what staff remain at some point during Friday. Just a little piece of news that I've noticed. I believe that Kanye West, or Ye as he's now known, I believe that his suspended account has now been unsuspended. I think we've got to change the story. This is a platform that has outsized societal impact relative to its user base, and what we want to know is how Elon Musk is going to change it. And also there's the thing about debt financing, John, because I'm pretty sure the bankers are worried about that one.
I'm pretty sure they're upset about that one. Ed Ludlow, thank you, sir, on the West Coast. Dan Ives of Wedbush doing something you don't usually see from Dan Ives of Wedbush, which is a price cut on Apple. This is what he had to say. In a nutshell, relative to other tech stalwart earnings this week, Apple is a clear standout and should start to get more focus as the Rock of Gibraltar name in large cap tech land, with Cook flying Cupertino through the economic storm. Dan, I'm pleased to say, joins us right now. Dan, this has been a tough week for big tech. Are you rethinking the thesis around any of these names?
Look, I think you got to sort of bifurcate. I think Apple and Microsoft, they're the ones that I think are all going to lead tech higher. I think those were ones that it's Cook and Nadella that were able to navigate the storm better than some of the other companies. So I think you got to bifurcate. I think if you look at a name like Meta, as well as some of those theses, that's a disaster. So I think it's not each in sort of hitting the same type of softness. I think you got to bifurcate the different stories.
Dan, what's the appropriate multiple to put on this name now, given their guidance for growth over at Apple?
Well, I think Apple, when you look at currency, it's about 1,000 BIP headwind. Yeah, X currency, it would be double digit in sort of every region. I think this is a re-accelerating from an underlying growth on services. I think you sum of the parts it, hardware business, services business is worth, we believe, about 1.2 to 1.3 trillion. I think this is, we'll say worst case 175 as we sort of re-accelerate, and I think best case is over 200. That's why we remain bullish, and this remains our top pick. And I think when you look at this carnage that we've seen in big tech, I think Apple relatively comes out smelling like roses relative to the other tech players.
Dan, I'll never forget an interview I did with the former Vice Chair of the Federal Reserve, Rich Clarida, and he talked about transitory. And I said, Vice Chair Clarida, how will you know if you're wrong? And when will you know? Dan, as a big Apple bull, how would you know if you're wrong about this company and your outlook?
I think if we do Asia checks over the next, call it 2 or 3 months, and we continue to see cuts in iPhone demand, then that combined with services starting to soften, that would be one where we'd be wrong on the thesis. And we're not seeing that, John, in terms of so far. I do think demand holds up well on this iPhone 14 cycle. I think what's different with Apple, and I'd say Microsoft as well, is that install base. I mean, they have that golden install base. That's how Cook's able to navigate this storm more than you see Zuckerberg and others this week.
Hey, Dan, good to catch up. Dan Ives, the pain
Thank you.
At the single name level in tech this week has been unreal. Apple may be the relative standout. I've been excited for this interview for a number of weeks now, and I'm pleased to say that Hugh Hendry, formerly of Eclectica, is with us around the table. Good to see you, Hugh. I don't look cool enough sitting next to you. I think I'm going to have to lose this tie in a minute. Thanks for coming into New York. I want to start with this. It's a comment I heard on your podcast, The Acid Capitalist, about a month or so ago. And you had an investor on that used a line that I've heard a million times. We've all heard it a million times. I'm long equities because over the 5-year period, usually equities provide me with a positive return. And you questioned that, and I think we all need to question that in this environment. What did you say back?
Well, I mean, it's the Warren Buffett line, never short America, and I certainly don't want to go against that. But also, it's the conceit and the arrogance of a well-formed argument. It is true. There has never been a 10-year rolling period where it's not been the right thing to be long. That doesn't make it right moving forward. There had never been a period where nationwide U.S. house prices had fallen together until it happened. And when it happened, it devastated the global financial system. And today, we're still trapped in the mire of what happened 15 years ago.
So you're saying that a century's worth of market data is not long enough? Do you have to take history back a little bit further? Is that how you think about this?
No. I mean, no, this is Asian philosophy. You only free yourself from the shackles of being a slave to market rhythms when you recognize the impermanence of things. Things change. Things like the Fed put, things like the Fed's understanding of money, things like the devotion to Dan in his rather spectacular jacket and his recommendation for Apple.
Yeah.
Things change.
Do you think the Fed's in a policy trap?
I think the Fed is confronted with Fed fog. Okay, I mean, again, I keep asking people, when was the last time we admired a step taken by the Fed that we thought, wow, yeah, that really has helped my life? Why is the default position to crash the economy?
So the hikes are the wrong call?
I believe the hikes will not result. They're dealing with a political problem that generated, hey, listen, without a doubt, we have seen an elevation to the tune of 10% in general global prices, right? And that 10% ain't coming back to zero. But for me, it's an elephant passing through the body of a snake, if you will, right? It refers to a supply shock, okay? It's gone. We're looking at Amazon's results, okay? Amazon had 100 warehouses full of inventory because they overestimated. And what's your headline again? We're looking at Amazon's worst holiday sales ever, okay? And we've had 2 consecutive quarters of GDP decline, and the Fed saying, recession? What recession? This is a recession that's getting bigger and bigger, and that's the fog.
You've picked up on it, the mismatch between demand and capacity. And there was a clear mismatch in 2020, 2021, but it was different. We didn't have the capacity, we just had tons of demand. Is it flipped already? Is that what you're seeing major signs of, that that's flipped already? And what does that speak to when it comes to the inflation call?
It's flipped. I mean, show me the evidence in the commodity sector in terms of the higher prices. Yeah? Show me the evidence. Actually, I'll show you the evidence in terms of the household's reaction. There's a default reaction whereby, think of the economy as like one giant wallet, okay? And the expenditure going out, we know, is up 10%, right, in general prices, okay? Sure. And so if you maintain your average consumption of goods and services, you need 10% more money coming into the wallet, okay? I don't see it coming in. This is back to the Friedman notion that inflation is always and everywhere a monetary phenomenon. You need a spigot of 10% coming in to accommodate. If it's not coming in, you're cutting back. Where are you cutting back? On discretionary spending. Let's look at every discretionary stock in the market. Where is it? It's on its ass.
So if we started a hedge fund tomorrow and we put together an investor committee, I'd have Mohammed Al-Erin as the chair to keep us well behaved through the whole meeting. I would have the likes of Druckenmiller there, the ingenuity of Druckenmiller. I'd have the conviction of a 90s Soros. I'd have the discipline of, say, Michael Platt over at Bluecrest, and I'd have you at the end of the table throwing grenades, saying, what if? If you could say what if right now, what is the big what if for you?
Heavens, you need a joker, yeah. It's the unintended consequences. And I keep looking with a wary eye at our Chinese cousins and friends, and I look at their currency. You've got to remember that they were allowed to devalue back in 1994 with NAFTA, yeah, to 9. Where's the currency today? It's like knocking on 7.5, right? It's having, like all currencies vis-a-vis the dollar, it's having one of its weakest, if not its weakest year-to-date performance. Heaven forbid it trades 9, because that's where the yen is going. You know, this is it's an Aesop fable. Yeah, why did the scorpion sting the frog halfway over? It's a bit like, why did Taiwan in 1998 devalue? There was no economic rationale. But when all the mercantilists are devaluing, boom, I can't give it up. That, God forbid that happens. That would be the most deflationary item to ever hit the global monetary system.
Is that something you'd be willing to position for right now?
Yes.
What would that look like?
Oh, that's a short position in the currency.
How would you express it elsewhere?
Well, you know, elsewhere with restraint. Like I keep saying, you don't always have to be invested in markets. People say, give me a safe, give me a riskless asset. Well, you know, I've lived long enough. I lived through 2008, and the safe asset, supposedly, gold, went from near 1,000 to near 500 because we got liquidation, okay? So for me just now, listen, it used to be, you mentioned in 2018, 19, the Fed was raising rates, the S&P went down 20%, the Fed went, I changed my mind. Yep. Yeah. Well, we hit 20, we hit 25, the Fed went, no, not this time. So maybe it's 30, maybe it's 35. Okay, my comfort level for trying to own any asset arrives when we pass 35 or 40.
You said something interesting a moment ago, though. You said many interesting things, but the one was that gold didn't perform. The asset that was meant to perform didn't perform. Is that treasuries right now, or do you think the surprise is still in our future?
This is the killing zone for treasuries presently, just chart-wise. Like this is where, you know, we'll see. Either the treasury bond bull market is over, and so yields will continue, or this is the point where we're just recirculating ownership. But in terms of, let's talk gold, let's talk treasuries, real rates, if we look at 5-year tips, are close on 2%. Our system doesn't work, and gold doesn't work when rates are positive, real rates are positive. Think of it, we've got debt to GDP circa 4x, okay? If real rates are 2, you're effectively transferring 8% of GDP from the debtor class, from the household sector, to the creditors. And the creditors have got no idea how to spend money. That's regressive, right? We need financial repression. It's just simple a function of the maths of 4 times GDP.
You're going to stick with us. I'm going to lose this tie. You know, we're going to catch up with Guy Johnson in London in just a moment.
Cool.
Team effort. Up next, the latest inflation numbers out of Europe, piling the pressure on the ECB.
Inflation remains far too high and will stay above our target for an extended period.
That conversation continues.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. You know, and the ultimate output for a company is share price. You know, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
Inflation remains far too high and will stay above our target for an extended period. In September, euro area inflation reached 9.9%. In recent months, soaring energy and food prices, supply bottlenecks, and the post-pandemic recovery in demand have led to a broadening of price pressures and an increase in inflation.
The pressure mounting on the ECB to deliver rate hikes just 24 hours after its last meeting. A host of inflation numbers out of Europe surprising to the upside and renewing recession fears. Guy Johnson out of London now. Guy, that print out of Germany, 11 handle.
You have got to go back to the 1950s. You've got to go back to West Germany, John, to see a number as high as that out of Germany. The Italian number was pretty ugly. The Spanish number was okay, but broadly, inflation is elevated and is likely to remain elevated within the Eurozone. I talked to Peter Pret yesterday, the former chief economist at the bank, and he was talking about the fact that Lagarde was, for the first time in a long time, he thought, balanced. She was acknowledging the risk to the downside, and she was accepting the risk to the upside on inflation. they want to manage it on a meeting-by-meeting basis, John. But I think if you see data like this, that is going to be a huge struggle for them. And I think a lot of the more hawkish members of the Governing Council are going to be saying, any idea that we were going to 50 is going to be tougher after today. We'll wait for the final number, the Eurozone number, but the German number is a big problem.
Hey, Guy, we all go back a long, long time. I think you and Hugh go back about 10 years further, so I've cancelled the next break so we can have a bit of fun here and talk a little bit longer. Hugh, did you ever think we'd see an 11 handle on German CPI?
Well, we're talking about going back to the 50s. Let's keep going back. Let's go back to 1948, when US CPI was running at 20%. And yet we don't talk about the hyperinflation of the late 1940s. Again, why? Because inflation is a monetary phenomenon, right? It requires, like, here we are getting funky in the studios of Bloomberg, right? But it requires funky banks saying, yeah, I want to lend. Do you see that in Europe? I don't see that in Europe, right? I see an elevation in the energy, right? And I see, believe me, right, the blindest bat of the central banking community is the ECB, right? The guys who raised rates in the summer of 2008.
And again in 2011.
And 2011, and what, they just doubled rates yesterday. Hallelujah, right? I'm thinking the other way.
You think the mistake is what?
I think the mistake is they don't understand that monetary conditions, they talk about financial conditions, monetary conditions, okay, have superseded their ability to see the entire picture. We're talking about the repo market, the euro-dollar market. We're talking about where monetary creation is no longer taking place within the sovereignty of their realm. They don't see it, and bad things are happening. The collateral is being called. Okay, money is actually being destroyed. The euro-dollar system just now is is contracting. Money is contracting, and it's pushing asset prices down. And it's a reflexive system. That's what they don't see. That will be the solution moving forward.
Guy, jump in here.
Well, I'm curious, Hugh, central bank independence. It's a very new phenomenon, and I wonder whether or not we're about to see potentially that being tested as well. Giorgia Meloni in Italy is already questioning the rate at which the ECB is raising rates. She, as you talk about the fact that this is a supply side problem that we've got here. It's not a demand issue that the Eurozone is facing. You've got the French president starting to talk about it as well. Others are likely to follow. How big a clash do you think we could see between politicians and central bankers, and who do you think will win that fight?
Well, I would extend that outside the European region to where you are in the UK. I think you just saw a cabal of the Bank of England chief and the jokers at the IMF, forgive me, but, you know, ousting the British Prime Minister for having the audacity to suggest a fiscal expansion in a depression. UK prices, the UK stock index is below where it was when we entered this new century, right? It's not growing. And what is the answer? To raise interest rates? I mean, what planet are these people on?
So what do you think the central bank should have done? What should Governor Bailey have done? Accommodate?
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one. This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Is like that, and you've got to expand your vision, and when you're out here, you're seeing dead people.
So we've got about 60 seconds left, and I hope you're not actually seeing dead people. Let's finish here. If I could summarize this conversation we've had, you're pushing back quite aggressively against recency bias, and we're all sort of blinded by what's happened recently. Is that the ultimate gist of what you're trying to communicate here?
It is, and I think we have to recognize that all of the fascination, we have to go back 120 years to Germany and the Weimar and the inflation. Why has it not happened here? Because we have fire breaks. We have the outsized position of publicly traded debt markets, and they reprice immediately, and they tighten policy, not the Federal Reserve. We have discretionary spending where people pull back. That's what's happening. And those two factors together usually mean that the inflation fear remains a fear. And as we move forward, metaphorically, I'm seeing dead people. Okay? And the Fed seems to be, that's what the Fed's doing. It has to trash our system. Yeah. Once we're all aware of how bad it really is, thank you, Amazon, for, again, guiding us that way, then the Fed will pivot.
10 seconds to make a trade, literally 10 seconds. If you could make one right now, what is it?
When I look at collateral, I'm beginning, again, the Italian BTP spread versus Bunds, right? Yeah. Only 15% of Bunds are in market hands, okay? And the Italian is being used as collateral as if it was a Bund. Italy is not Germany.
Hugh, it's longer than 10 seconds, but we got to go. Hugh Hendry, thank you, buddy. It's good to see you. Thanks to Guy as well. Live from New York. This was the countdown to the Open.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect
disruptors like you.
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in five stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation